Welcome back. Hope you're having a good morning. For starters, the GIFT Nifty was suggesting a bit of a flattish or mildly negative start of closer on 40, 50 points. So they're about 60 points now is what we're bracing ourselves for. But plenty of stocks, a lot of action. Deepan Mehta, Director at Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Good to see you. Few good earnings came out overnight. Case in point being a Tata Consumer, though the stock has jumped up. And also we had positive numbers coming in from LTI Mindtree, and Persistent System looked very, very good. Among the three, do you like any of them?
No, Nigel, none of them. If you call 2-3% type of a growth as good, I don't know, what is good then. So whether all the tech companies, the results so far have been disappointing, except maybe for Persistent System. There also, eventually growth will slow down because of base effect and the uncertainty. So I think it's time to get extremely cautious on the software services company. And what is even more disappointing is that the management say that a 2-3% type of a quarter-on-quarter growth is a strong quarter. Means what has happened to the ambitions of the software services companies which were driven by entrepreneurial spirit? Now they are more than happy with a mid to high single-digit growth in sales. So I'm just very disappointed with the sector as a whole. And there are a lot of secular headwinds. This GCC is going to play a big role in reducing their growth rates. And of course, there is this entire sword of slowdown in US, which may affect tech profits. So we are getting more and more underweight on the software services side. There could be a few exceptions, companies which have a differentiated business model. But by and large, don't get enthused by a 2-3% outperformance versus what the analysts are expecting. And just because stocks are cheap. So I would still avoid the sector completely. Tata Consumer is good, but look at the valuation. I mean, the PEG of 6-7 times or so. You can't get solid money or get great returns or wealth, build wealth through Tata Consumers by buying at these levels. That's my conclusion.
Deepan, that's on Tata Consumer. Of course, today lots of other consumer companies are also reporting. Nestle is reporting, Lever is reporting. We all know, there's no growth there either. But, maybe they're not as expensive as they used to be. Would you look at any consumer stocks at all on the FMCG side?
Yeah. Good morning, Surbi. The biggest mistake I have made in life is to buy stocks which are cheap. And because they have corrected and valuations have come out, because the valuations have come out because there's something fundamentally wrong. And in the FMCG sector, a lot of categories have become mature. The growth rate, underlying volume growth rates of many of the FMCG products is now linked to the population growth and not the GDP growth rate. And that's a very important distinction because you're in a country where you have a nominal GDP growth rate of 10% plus. Then why aren't these companies growing at 12-13% or so, or growing at 4-5%? That's a question you have to ask. And the reason for that is that the penetration levels have reached deep. All the benefits from getting into the rural areas is now over and done with a lot of these companies. And end of the day, I think consumer spending on FMCG products as a percentage of their income has remained static or gone down. And now there are many more avenues for the consumer to spend, be it in retail, travel, hospitality, healthcare, education. There are many more needs. And the Indian consumer has fast changed than what he was about 20 years ago.
I call it the mid-single-digit jinx, Deepan, because that's what this whole sector and many of these companies have been in the severe grip of, this mid-single-digit growth. Will it be any different for Lever this time around? Since we're on the subject, let's bring in Mangalam and get the expectations going. Mangalam?
You call it the mid-single-digit jinx, and will Lever be any different? Yes, it will be, because it will be low single-digit and not mid-single-digit this time around. Demand conditions are very similar to what they were in the third quarter. 0 to 1% domestic volume growth is expected, not too much. 2% underlying price growth, and that's largely because of palm oil prices increasing, and at the same time, tea prices increasing as well. So there would be that portfolio-led price increase, and the company will navigate through their margins by reducing their ad spends from closer to 11% of sales to about 9.5 to 10% of sales itself. Put all of that together, what do you expect for Unilever? A 2% revenue growth, 15,161 crores. EBITDA grows at 2% as well, with margins staying stable at that 23.1% mark itself. Net profit higher by about 3% at 2,475 crores. Personal care segment likely to grow between 0 to 2%. Beauty and wellness, which is a category which has been growing fast. We've seen that in the case of Nykaa as well, likely to grow much better than the overall portfolio at around 4 to 5%. So that's mid-single digit growth for you. Home care and food expected to grow around 2 to 3% or 0 to 2%, depending on the way you look at. More important than the numbers this time around would be the management commentary on scaling up of operations and what their expectations from FY26 is when it comes to urban demand in particular.
2% volume growth, Mangalam, right? That's what you said, overall 2%.
0% volume growth and 2% revenue growth. 0 to 1% volume growth.
0 to 1% volume growth. When a giant like Lever, with its muscle and might, its distribution power, its marketing power, tells you there's 0 to 1% growth, and this is all across the country. It's pan-India growth that we're talking about.
Yeah.
Through channels, I mean, e-commerce, direct, kirana, everything put together, 0 to 1%. That's telling you something, that the market definitely is listening.
Well, indeed. Deepan, I wanted your view on a sector that could grow, though, going ahead. Dalmia Bharat. The numbers are pretty okay. I think after a few years, the last time we chatted, you were sounding at least a little bit more interested in the cement names. It's domestic facing. Cement prices have moved up. Input costs have come down. Q1 should be better than Q4. Anything you like from the cement pack? And if you had a closer look at Dalmia Bharat's numbers?
Yeah, Nigel, we are getting constructive on the cement sector. I think it's in a nice cyclical upswing after 2-3 years of downswing. And Dalmia Bharat being the fourth largest cement company certainly should do pretty well. Bit disappointed with the volume numbers because the growth in profits has come through lower costs. Typically, we want the volumes to go up in the cement industry to get more and more confidence in the sector. But yes, I think given the kind of construction activity and so many real estate projects have been announced, they should start getting into construction phase as well. And with the elections and all over and done with, execution also will pick up. So we are very positive on cement. The favorites over here with the usual disclosure that we and our clients are invested are the Adani Group company, that is ACC and Ambuja, where they can squeeze out more efficiency, especially in ACC. And they're very aggressive when it comes to M&A activity. The group itself is a captive consumer, and they have great plans for these companies, and valuations are reasonable below the other larger companies, be it Ultratech or even Dalmia Bharat or Shree Cement for that matter. So there's at least a slight opportunity of a P getting re-rated higher. So generally positive on cement, I think, and I think that these two companies will outperform the rest of the market.
Valid thought, Deepan, and good to hear after a while you're getting constructive on the cement space with good reason, as you explained that to us. Stay with us. For the time being, we slip into a short break. Come back. Our technical experts will be joining in as well.
Welcome back. Just about 15 minutes to go before we hit the pre-open session. Good time to bring in our technical experts. Actually, not the pre-open session. I meant the open session. We're already close to 9 o'clock. We have Sudarshan and Mitesh joining in, as always, with the technical setup. Gentlemen, good morning to both of you. So the market is in cruise control mode nearly. Yesterday, banks took a bit of a pause, but then other sectors made up for it. Sudarshan, so what would your sort of trading direction be, and specific index calls first?
Yeah, good morning. See, my trading direction would be completely away from the market. Yesterday, I suggested that we are getting a gap up. Use that gap up to close all your long positions. And I think that view continues today. This doesn't mean the market is going to turn down or we are going to go short, far from it. What it means is that markets will become choppy and sideways. You know, a trader will always find it difficult to trade choppy markets. So it's much better to step aside, wait for a couple of days, 3 days, whenever the markets start giving signs of life again. I would expect a lot of choppiness for the next few days. So stay away, cash in your profits on the long side and just watch it.
Okay, all right. Cash in your profits on the long side and wait by. Got it, Sudarshan. That's your take. Mitesh, what about you? Would you participate on the upside?
Nigel, I've been maintaining a long bias, and I think that still remains. The setup on the short term and the medium term charts is positive, except for the fact that we are slightly on the overbought side, which means that now instead of buying at every moment, every chance, every opportunity, I think you've got to be slightly smarter and you want to wait for some kind of intraday dips to take fresh positions. If you're holding long position, then you can just keep trading your stop losses and be happy about it. But for somebody who wants to enter a fresh, I think any kind of decline, intraday or maybe a 1-2 day kind of a pullback to the 10-day average or to a gap support pivot area, I think would be a fresh entry point. And that's the way we'll approach it. But on stocks, yes, you would still be trading with a long bias, clearly because my belief is that the market is poised to go higher.
By the way, congratulations, Mitesh. Yesterday, we started 200 higher, lost 100, and then I think came back once again. So it was good. I mean, I think it was saying that buy the intraday dip in that sense. Gentlemen, morning. Sudarshan, what would you do in terms of specifics?
Well, Asian Paints is a buying opportunity with a stop under 2410. GMR Airports is a buy with a stop under 85. I have only one intraday short because I'm not bearish on the markets, just choppy. Voltas is an intraday short with a stop above 1335. And finally, ICICI General Insurance is a buy with a stop under 1845. This is a good time to focus on stocks rather than on the index.
Okay. Mitesh, what about you?
I would, have all buy calls today. A buy on Aurobindo Pharma with a stop at 1220 for targets of 1300. A buy on Cummins India with a stop at about 2920 or 2923 and a target around 3060 can be looked at. Alchem Labs is a buy with a stop at 5195 for targets of 5320 and also a buy on ICICI Pru. It's a conditional buy. So it's been, making those intraday highs around 610, 611 for the last 2-3 days. Once we start getting past 612, buy with a stop below 600 for a target of 635.
Okay. Let's just look at the dollar rupee as the market is opening up. Mitesh and Sudarshan, thank you very much for that. The pre-open is also kicked off. By the way, the dollar rupee, the rupee basically weakened about 0.3% in the offshore non-deliverable market last night on the back of these the Pahalgam attacks and of course what may follow. So markets very much focused on that as well. So this morning 85.60 or so on the rupee, dollar rupee, which is coming through. 50 points lower on the Nifty, but this is, initial first 3 minutes of the pre-open session in focus. Let's talk about IT, guys, because the index was up 3% yesterday.
Yeah, big pullback on the IT side of the market. And I think we have a guest.
Well, that's right. Let's get straight to it. We have a lot of numbers that come in there. And the good news is the last couple of trading sessions, we've got some positive surprises. HCL Tech delivered a fairly good set of numbers. The index was on fire yesterday. And you have LTI, Mindtree, as well as Persistent System that did quite well. Sandeep Agarwal, fund manager at Subilo Investment, joins us on the show. Hi, Sandeep. The stocks pulled back a goodish bit. Yesterday, the index itself was strong. But these numbers coming from Persistent in particular looked quite good. What's your view?
Yeah, hi, good morning, and thanks for having me on the show. So, to start with, Persistent have been delivering quite well for the last several quarters. And, I think they have got the very good grip on the ER&D piece of the business and they have been delivering on top of that. So I think that is an exception. If you see across the board, they have been delivering quite robust number for several quarters. And I think, they have good client stickiness and consistent flow of deals. So that is a very good number, to be honest, in this environment.
So, Sandeep, hi, good morning, Surabhi here. So, what's the overall way to play this? When companies like Persistent, even Coforge, they've anyway been coming out with industry-leading growth, right? They've done so much better. Coforge, 35%. Persistent last year grew at 18%, still sounding confident. So do you stick to these names or would you perhaps be looking at even IT services because of, I don't know, maybe valuation comfort, cash levels or something like that? Because growth clearly is still missing.
So, what has happened is with that, you see IT has underperformed massively in last few months and now they have come to a level where some of the large caps are now at 4.5 to 6% dividend yield. And, across the globe, there are many funds, dividend funds, which have very limited options to buy for dividend stocks. And for them, these stocks now have become quite attractive. And because of that, you would have seen the kind of movement you saw yesterday. In fact, in last 7-8 days, most of the stocks, whether TCS, Infosys, they have moved up almost 10 to 12%. And this is primarily because of the FCF yield. But as you rightly mentioned, growth, I think, will be very challenging. And remember, in IT, 80% is top priority, which cannot be changed, delayed, postponed, nothing. Balance 20% is last priority. It is discretionary. So it only comes when environment is extremely good. So I really believe that, for the IT services firm, growth this year will be challenging. For large cap, 3 to 5% is also a very tough ask. And for good quality mid cap, even low double digit will be challenging. So given that scenario, the PEG ratios are between 3 to 6-7 times. So I don't know whether that kind of PEG ratio should be assigned to a sector which is growing at such a low rate. So that is my concern. So valuations are still not very reasonable, to be honest.
But within this universe, I mean, would it be mid-cap IT over large-cap IT? And names like what Surabhi said, Coforge, etc. Coforge, for example, reports over the weekend. So if, these companies say, well, deal pipeline is looking pretty strong and, they indicate, you think there is still a price dislocation, which is there between, because stocks sold off from 10,000 to about 6,000. It's come up now, of course, 20-25%. What's your sense?
So, as you mentioned, Persistent in the ER&D has been delivering very solid numbers. And similarly, Coforge in the services side has been delivering quite good number. But my concern is that, in ER&D, there is a different reason why the stocks were doing well. And I think they will do much better than IT services in long term. But given these challenges, which we are seeing early signs of challenges in the auto space in Europe, I think, even ER&D can have a lag effect. So remember, these are very long-term deals and it takes time to slow down and it takes time to pick up. So I would not read too much on just quarterly number. In my view, the pickup will also show first in the large caps, which I don't think will happen in first half of FY26. So I think there is some slowdown which you will see in these good quality mid caps, which are still giving good numbers. And these are on back of the past orders which they're executing now. So I think some slowdown in good quality mid caps is yet due. And the large cap, I think they will be the first one to start reporting good numbers, but they are also at least 2-3 quarters away. That is what my sense is. So I think, we have to be very careful. Where there is 5.5-6% FCF yield in large cap, probably they would have been closer to bottom. But otherwise, I don't expect too much on growth this year.
So that means that since you're saying the auto sector is unlikely to offer any respite to these ER&D companies, I'm looking at Tata Elxsi. Let's get long-term charts in, maybe one-year charts. Tata Elxsi and even KPIT. The stock, Sandeep, interestingly, in the last 3-4 weeks, started showing some signs of life, even as this whole tariff storm was surging around. Now let's pull up a 1 year. Look at the value destruction. And then this little excitement building up, pretty much in the last 2 weeks. You're saying this is a bit misplaced for stocks like Tata Elxsi and specifically KPIT Tech?
So I will not call out any name because we run a PMS, but let me put it this way that, I believe that auto will give some pain to ER&D companies. And when that pain comes in, as I said that, right now they are executing what they have won in the past. So going forward, I think there will be some slowdown in all these companies which are in the ER&D space, and even the IT services, the growth which you have seen in some of the mid caps, which was very high. I think that will pull off a little bit. See, large cap, you see the impact immediately because in large cap, what happens that, they have to get that 20% and that 20% discretionary is a very big number. But for mid and small cap, it takes time to show the, to bring down the growth and it takes time to pick up the growth. So I think, first sign of any recovery in growth will show up probably in second half of FY26 by large caps. And after that, after 1 or 2 quarter lag, maybe good quality mid caps will start showing you growth. So I think at current juncture, if anyone has to seriously look at it, then the only parameter to look at will be the free cash flow yields, which wherever you have 4.5 to 6% range, maybe investors will start nibbling there. But I don't see any other growth reasons to buy the stocks right now.
Okay, all right, Sandeep, we'll leave it on that note. Thanks very much. Good to have that perspective. Stock prices do these things, those, pretty big moves, flash in the pan kind of moves that we've seen earlier this week, yesterday as well. But some longer term perspective always helps. Thank you very much for joining in. Time for a 9-10 calls. Let's quickly look at what the index is doing. 51 lower, very much in sync with what the implied low, open was telling us. Bank Nifty is also down about 0.5% at this point. So Darshan, what would your 9-10 call be?
That will be ICICI General Insurance by ICICI GI with a stop under 1845.
Okay, ICICI General Insurance, got it. Mitesh, your stock.
I'll go with a buy on Alchem Labs for targets of 5,300 to about 5,320.
Okay. All right, gentlemen. Thank you very much for joining in with those calls. Let's also put the spotlight, obviously, on the biggest national story of the hour and an extremely important one. The union government has convened an all-party meeting later this evening. It's probably going to happen this evening, and this is in the aftermath of the attack that left 26 people dead and several injured in Pulwama. There was a cabinet committee on security meeting last evening, and some very, very strong diplomatic actions were announced at the end of that meeting. Parikshit is joining in. Parikshit, it's pretty historic, right? The Indus Water Treaty in abeyance, Pakistani nationals being told to leave the country in 48 hours. What are the next steps? What does today look like?
Well, Pakistan chargé d'affaires, the top diplomat of the Pakistani embassy here in New Delhi, was summoned last evening. He was handed over papers asking him to make sure that the defense attachés of Pakistan and India, the military attaché, the air attaché, the naval attaché, all of them leave the country in the next 7 days. So literally, they have been expelled from the country along with their 5 support staff. SAARC visas for Pakistani nationals, they have been suspended as well, even those which were issued earlier. So all of that have been cancelled, and all those nationals who are in the country, they have to leave in 48 hours. The Atari checkpost, which is used to cross over into Pakistan and for Pakistani nationals to cross over into India, that has been shut down, and all nationals from both sides have to return as well. So we are looking at diplomatic measures. We're also going to see perhaps more action in the next 2 to 3 days. India is deliberating on various options on how to isolate Pakistan diplomatically. We've got an outpouring of support from various countries, including the US, including the European Union. And India is going to use that support to somehow expose Pakistan and export the linkages, the direct linkages with the Pakistani state as far as this terror attack in Pahalgam is concerned. The Indian government is saying it is very clear that normalcy, economic prosperity was returning to Jammu and Kashmir. Successful conduct of elections is something that has not gone down well with Pakistani state actors, and perhaps this is the reason why Pakistan has sponsored this terror attack. And it is clear from the manner, the modus operandi used by the terrorists, they were not locals. The fact that they were asking for identities of the individuals means that they were not from here, and they could have possibly been members of the Pakistani armed forces or Pakistani commandos as well. So a multi-pronged strategy. Pakistan itself is going to hold a meeting of its National Security Council. They are going to retaliate with similar measures, diplomatic measures that India has taken. So let's see how the ball rolls from here on. But it is going to be a tense period in India-Pakistan relations once again.
All right. Parikshit, thank you very much for that. And we'll of course, keep coming back to you for updates on the story throughout the day. Lots of focus on this from a financial market perspective as well. Tata Consumer is the stock we want to shine the spotlight on. Mangalam is here with why. Mangalam, morning.
Good morning. So Tata Consumer reported its numbers yesterday. While the overall results were largely in line, there were a few bright spots that the company reported this time around as well. If you look at the revenues, they were above street expectations by about 25 to 30 crores. The EBITDA, despite a 420 basis points decline or contraction in gross margins, actually were better than what the street were expecting, and the net profit was further aided by a 45 crore exceptional gain that came by as well. If you look at the categories as well, in the India beverages business, the organic revenue growth was close to around 9%. The street was working with a number of 10 to 11%. Foods was where the bright spot was. Organic growth out there was 17% as against expectations of 11 to 12%. Partly led by growth businesses, partly led by the price hikes that the company had taken in their salt portfolio, and partly led by a strong performance of their other verticals as well. The international segment grew by about 5%. The street was again working with that number itself, largely led by US, but there was a decline which was expected in the UK, and that's exactly what has happened. The brightest spot for me was the growth that the company reported in their non-branded business, which was 25%, led by 60% growth in their plantation revenue. And secondly was the Nourishco business, which came back to growth after 2 quarters of underperformance. A 10% growth is what their Nourishco portfolio reported this time around, with an 835 crore revenue for the entire year. See the stock mild green after a strong outperformance this month.
All right, Mangalam, thank you very much for that. We're starting 50 points lower on the Nifty, so 24,288 is where we're at. The Nifty Bank is down about 0.3%, 55,184. Sensex is down about 0.17, 79,978. And I think you got some green on the small cap index, 16,980. Mid cap index is absolutely flat, but there's some green on both in the broader space, broader markets. Otherwise, I mean, it's slightly sideways, slightly subdued. It's 12% in 9 days on the Nifty, and running into, of course, some adverse news flow here as well. So 24,280 is where the index is at. The Nifty heat map maybe will quickly come up, and we'll just look at which way things are. So it's all mostly down. I mean, I think about 30, 35 stocks are lower, and about 15 odd names are higher at this point in time.
And Bajaj Finance is in leadership position. I'll tell you why. Because the board is meeting today. They'll be considering not just a dividend, but also a stock split. And typically retail investors like that. Just makes ownership a little easier. Stock at an all-time high this morning of about 9,450, almost 9,500 on Bajaj Finance. So that's the big mover. Tata Motors is the other one that's tracking some green. There's IndusInd Bank on the upside. Nestle ahead of numbers is up about 1%. Let's look at Tata Consumer and see what it's doing. Tata Consumer is actually down about 4%. So the stock's selling off on what seems to be an inline performance in the fourth quarter. Tata Consumer actually is the weakest stock on the Nifty. With that cut coming through. Eternal, which has had a good week so far, it's cooling off as well, 2% lower on Eternal. And there's news on Eternal as well. Let's not forget, there is a management change. Mr. Dipinder Goyal himself is going to take over the food delivery operations now. The current CEO is moving out to another business, still in the company, but to another business. It seems like it's a regular reshuffle, but the stock is lower. Bharti Airtel, Sun Pharma, HDFC Bank, these are the other losers. Banks in general are a little soft again this morning. ICICI Bank also lower by about 0.5%. Kotak is also slightly lower. L&T Cipla also slightly down. So very muted and quiet for the time being. IndusInd, by the way, is seeing some interesting buying, about 1.5% up on IndusInd.
Well, that's right, Surbhi. And a couple of more stocks actually that are calling for our attention. Thyrocare, solid set of numbers. There is valuation comfort out there. So that's the big bazooka move this morning. Thyrocare is up close to around, I think, 8-9% the last time I checked. Let's get the intraday chart up for you on the screen. Syngene, disappointing numbers with disappointing guidance as well. Waaree Energies, that's the one that's given up a little bit post yesterday's big run. So that's coming for some profit taking. Vascon, well, that stock is up close to around 5% or thereabouts because it won a 200 crore order. Syngene now it's down close to 10%. That's actually a lower circuit on that particular name. So just keep an eye out on that one. Vascon is up close to around 6%. That's won a 200 crore order. So I think we should get that as well up for you on the screen. It's at the 100 DMA. So keep an eye out on Vascon. Spandana Spurti, the stock started off in the red, but it's recovered from the low point of the day. A few factors at play. Mr. Ashish Damani that now takes charge, he's been longer there than Mr. Shalabh, so that's why that could be one factor. The management commentary as well was positive, that they see settling down of this MFI stress in a quarter or so, which is another positive, and valuations at around 0.85 times give some kind of support. So because of this, after starting off gap down, and yesterday the stock was down 5% as well, that's recovered from the low point of the day. And Dalmia Bharat, as we said, the numbers are more or less flattish. The way ahead could be better. That stock is up 3.5%.
Absolutely. So lots of movers, right? I mean, we're still on the Nifty down about 45, 50 points to start the day. And the biggest volume-led loser, I mean, price-wise, it's just a 3% cut is Waaree. But look at the volumes. It's huge volumes coming through on Waaree Energy. and at 29.35. Yesterday, of course, it was up some 16-17%, but almost quickly clocking up to about 1 million odd shares on the NSE. LTI Mindtree, of course, Rima was highlighting that. Syngene, we've highlighted. Tata Consumer, Mangalam just spoke about that. It's down 3%. Eternal is down 1.25%. Max Health is down 2%. K Fintech, big winner in the last 1 week, 2 weeks, 3% down, about 12.50 on K Fintech. And so on and so forth. Rallis is down about 5.5%. It's got decent sized volumes as well, but not high, but some volumes in it. And of course, I mean, Samhi is up 5%, so 182. Stocks up 25% coming into this deal. It's up another 5 this morning on Samhi. So yeah, I mean, there's a fair bit which is going 60 points lower on the Nifty. So,
you know, on Tata Consumer, I started going through a lot of the brokerage notes, but just to sort of gauge market reaction and pulse. Jefferies is the one that's actually downgraded the stock. And what is their rationale of doing this? They're saying, first of all, this tea inflation is really hurting margins. They're not too happy with that, though growth is okay. And more importantly, they're pointing out the obvious. The stock is trading at 70 times FY26 earnings. So they just think it's too expensive. So therefore, it's a hold now for them. That's a Jefferies view on Tata Consumer.
Absolutely. So 2.5 lower on Tata Consumer. Dheeraj Agarwal is Managing Director at Ambit Investment Managers. Dheeraj, good morning. Good to have you back on the show. Thank you for your time. What's the view now, Dheeraj? Have 12% in 9 days on the Nifty. And, you know, you're again, gains come so quickly, you just snap back that you're left wondering, what now? I mean, you know, and stocks uniformly are up 20-25%. I'm talking about, say, BSE 200 or a well-tracked group of stocks. What's your view from here?
Yeah, so if you actually zoom out a little bit and ignore the fast down and fast up moves, market continues to be in a large struggle zone, right? So it falls very fast, it comes back very fast without actually going anywhere. So the last time I think we discussed on your show, I basically said, look for 1 or 2 years of just single-digit kind of returns. And I think I maintain that view. But it will be through bouts of optimism and pessimism where we will see sharp moves on both sides. So it's not one of those kind of markets where you'll see a vertical down kind of a correction. For that, you need some big shock to happen. I mean, the tariff issues could have provided that shock, but India looks like a bit of an island of safety or oasis of safety within the whole tariff war, which is currently going on. So I broadly maintain it's a large range market. We will keep on doing top of the range and bottom of the range many times before the mean reversion actually happens.
So continue to be a little cautious in the market. Dheeraj, good to have you with us on the show this morning. Now, so what is the issue? And for a second, I'm just leaving aside this entire trade uncertainty and whatever's happening with tariffs. Hopefully, we'll get a better deal. At least that's what the market believes, right? That India will probably get a much better deal than a lot of other countries. That aside, why else are you far more cautious? Is it that you're not convinced about this whole earnings recovery story? Is it something else?
So two things, Surabhi. One is you can't fully ignore this whole tariff issue, right? Because to my mind, one thing is very clear: the current disruption or change in the global financial order, the global trade order, which is happening, has two clear implications. One clear implication is there will be a slowdown in global economy. Now, we will have to wait and see whether the slowdown is shallow or deep, whether it becomes a full-blown recession. But I think it's pretty much a given there'll be a slowdown in the global economy, and India can't remain fully protected or shielded from the fact that the global economy itself will slow down. So that is point one. Point two, domestic economy itself has been slowing down for the last few quarters. I mean, we can see that in the top line of Nifty or BSE 500 earnings. Bottom line has been telling a different story because of the margin uptake which happened for a few quarters. But the top line growth has been anemic in the region of 7 or 8%. Domestic economy has been slowing down. So if you add on top of a slowing domestic economy, a layer that the global economy will also slow down in the next few quarters, I think earnings will see more cuts. So as you rightly mentioned when you were discussing one of the stocks that brokers are downgrading because of valuations despite okayish earnings. So that's the challenge. When where the earnings are okayish, valuations are too high. Other places we are seeing a little bit of earnings downward pressure. So both these two things will keep the market in a bit of a struggle zone, I think, for some more time to come, according to me, another year or so.
So, Dheeraj, where are you on earnings, if I could just ask? Because the street consensus, when we kind of began, FY26 was supposed to be somewhere around 12 to 14%, depending on whom you're listening to. What is your base case expectation?
So this is just a very, very top-down guesstimate. I don't have estimates. So very, very top-down guesstimate looking at the way cuts are still happening in many spaces despite good results. I would say we would end FY26 in high single-digit range. So 7, 8, 9, that kind of a range.
And that's not in the price, is it, Dheeraj? 7 to 9% earnings growth this year. That's not in current stock prices, is it? Or is it?
I don't think it is. I don't think it is in the because that level of earnings disappointment is bound to slow things down, right? So I mean, there are two things which are playing in the market. So one is the narrative of what is happening on the global scene. Second is the actuals, which is the earnings. And in the near term, India actually benefits from the narrative that India is an oasis of safety in the tariff war. India has a very good relationship with the US, and we are trying, and that's a fantastic job achieved on diplomacy by the current government to do a trade deal with the US fast. And as a supply chain alternative, this is the third time in the last 17 years that we are staring at a wonderful opportunity of making India a supply chain destination. Whether this time we are able to do it or not is a question. We will see going forward. But these three narratives are playing on the positive sentiment on the market. But if you look at the earnings itself, weakish, nothing to write home about. And there's no upward revision in any of the earnings which are coming out. Either it's flat or we are seeing downward revisions.
Okay. All right. That's a sobering thought and one we must take on board. And perhaps eventually they say earnings is the fuel of every market. And if we're looking at more cuts ahead, it could be maybe a little problematic. All right. Got it. Thank you very much, Dheeraj. Good perspective this morning. Appreciate you joining us on the show. For the timing, we're moving on and putting the spotlight on a big deal that just got announced, SAMHI Hotels. And this is exactly in step with what Nimesh was telling us earlier. Now, we have the management of the company with us to talk about their strategic deal with GIC. GIC is all set to acquire 35% stake for a total of about 752 crores in 3 subsidiaries of SAMHI Hotels. Ashish Jhanwala, Chairman and Managing Director and CEO at SAMHI Hotels, is with us. Ashish, great to have you. Thank you very much for joining it. Good morning and congratulations on a big deal. GIC is a marquee name. Now let's go through the whys. I know you want to use a lot of this money to pare down debt, but what exactly is the transaction with? What are these 3 subsidiaries and how soon does the money come in?
Thank you for having us. Absolutely, we're very excited about this transaction, largely on account of the quality of partner that we are getting. So I don't think I like to belittle the whole transaction by just only focusing on leverage. Clearly, that's a great end result. But what this gives us is a strong partner for future growth, especially in the upscale and higher category of hotels. As you've mentioned, we have picked up 3 of our existing hotels where GIC has picked up 35% stake against a total investment of 752 crores. This does multiple things. It reduces our debt significantly, on closing. That frees up a lot of our free cash for future growth. And in addition, GIC and SAMHI are committed to growing this whole partnership to about $300 million. So we do expect both partners to put more capital for future growth in this business. In terms of timing, the deal is subject to customary approvals such as shareholders' consent. We believe this should be in place by end of May. And majority of the investment comes upfront. We should get done, I would think, by June end. And the balance comes in Bangalore asset over the next 2 years. But majority is coming.
What you said, actually, sorry to come in, but what you said was very interesting. And I was just going to ask you that. Is this the first of more or the first of many? And you said the partners are committed to putting in more capital. So are you open to selling more stake? Could you be looking at deals in other properties as well?
No, so I think the larger part of the deal is that we've incubated the deal with these three assets, but both the partners will look at new acquisition opportunities in the space, wherein both of us will bring future capital to deploy. So it's not just about SAMI continuing to bring more assets in the platform. That clearly is an option. But I think the bigger focus is to also look at opportunities outside. We've had tremendous success over the last decade in our acquisition strategy. And we believe getting a partner of GIC's stature and obviously kind of fixing a balance sheet, both of them put together gives us tremendous appetite and potential to grow through acquisitions.
Ashish, hi, good morning. Prashant here. Congratulations on the deal. So just to understand, is this something similar to, so GIC was an anchor investor with DLF, for example, right? Early anchor investor. Or, for example, if you take a look at the case of Max Estates, again, another real estate company, but also sort of operates commercial properties, etc. They have New York Life as a kind of anchor investor, and they go asset by asset. Is that kind of the roadmap to think about this?
Prashant, hi, yes, absolutely. Besides the three seed assets, both the partners will look at new opportunities on an asset by asset basis. And if both the partners like the opportunity, we are committed to bring in capital in the ratio of 65-35, 65 from SAMI and 35 from GIC.
So that is in the agreement. Anything you do in the future, it'll be in this 65-35 ratio.
In the upscale space, Prashant. As you know, our business is spread across upscale, upper mid-scale, and mid-scale. The joint venture that we've set up, or the partnership that we've set up, is targeting the upscale segment. So hotels that we look at in the upscale space, we will have to take it to the joint venture or the partnership first before we do it on our own balance sheet.
Okay. All right. Hi, Ashish. Good morning. Good to see you in. Nigel on this side. Could you tell us what's the contribution of these three subsidiaries in terms of revenue as well as profitability to the entire, the listed entity?
So Nigel, about 30%. These entities put together contribute circa 30%. I'm talking December 2024 numbers. If I take trailing 12 months as of December, about 30% is a contribution to revenue and EBITDA of these three hotels to our overall portfolio.
Got it. Okay, all right. Now, the net debt has steadily been coming down. If I look at it, when you joined us a couple of years ago, it was 2,800 crores, then it came down to around 2,000 crores, and you had told us in the time to come, it will reduce. Now, post this fundraising that you have done, what should the debt number be, say, by the end of FY26, FY27? What's the rough number we can work with?
So immediately on closing, the net debt will come down to about 1,460 crores. Interestingly, that absolute number, Nigel, helps us achieve a target of near-term going below 3.5, within a year going below 3 times, and fairly quickly getting to our stable target of 2.5 times net debt to EBITDA. Therefore, we can look at deploying a lot of our free cash towards growth, but we believe our net debt will remain in the zip code of 1,000 crores to 1,400 crores over the next 2 years. It all depends on what's the deployment of our free cash. And it's an important perspective because we will see almost a 55 crore reduction in our interest expense on an annual basis. So our free cash growth will be pretty substantial. And if we can find acquisition opportunities, good. Otherwise, a lot of that will eventually end up reducing our leverage beyond 1,470 crores.
Okay, all right. Ashish, you've given us very good numbers. So, thanks for that. But if you could tell us, it's too early to talk about, they're just entering, but what's the exit plan for GIC? Is there already a structured deal or something that you'll have already worked on? Or you said that they could be interested in other assets as well. Will they deploy some more capital?
Yeah. So I think the intent is for the partnership to grow substantially and both partners to put more capital. And Nigel, with that, I think it's too early to talk exit. We both are very excited about both India as a market, hotel as a sector, the acquisition and turnaround strategy that SAMI has deployed over the last decade. So I believe there's a lot of growth that we can leverage in the cycle and in the sector. There are obviously provisions for monetization of investors' stake. But Nigel, we have a credibility and experience of working with institutional capital for the last 14 years. So if any point of time in future, there is a requirement of monetization, we feel that should be an easy path.
Ashish, that 65-35 ratio that you mentioned, right, for future projects, upscale hotels, as you said, could you give us a sense of what the number of keys at SAMHI right now is? And you already have a pipeline, right, of identified upscale properties. What is that number? And in how many of those cases will this 65-35, will GIC come in? As things stand right now, yeah.
As of today, as I said, they are in these 3 subsidiaries. These 3 subsidiaries will eventually own 5 hotels. The Courtyard Fairfield in Bangalore Outer Ring Road, which is an operating asset, the Hyatt Regency in Pune, which is an operating asset. And, we had acquired the Trinity Hotel in Bangalore Whitefield in October, which eventually will be rebranded as Tribute under the Marriott portfolio and a new Westin block. They are currently picking up 35% position in these 5 hotels across 3 subsidiaries. As I mentioned earlier, we are keen to evaluate more opportunities to add to this portfolio, but I really don't have a definitive agreement on any future pipeline that I can discuss today. But the plan is to definitely grow this partnership using both the opportunity, the capital, and the skill sets we both bring.
So, Ashish, just on that point, because you've given us an idea of the debt levels, you're saying that after the paring down, debt will not exceed 1,000 to 1,400 crores. At the same time, obviously talking about, investing more in the business. So, at least from SAMHI's point of view, what is the additional capital requirement that you see to deploy into these 3 entities and even overall otherwise? I mean, give us some sense of the leverage levels that you'll keep at a debt equity ratio, and how much more capital will you bring in? What's the plan on the equity capital side?
On the debt levels, we've had a fairly committed position to the investors. We had said 3.5 times near term, and 2.5 times is what we believe will be a good, healthy, steady state, given the fact all of our debt is pretty long-term, 12 to 14 years, right? So we will get below 3.5 times on closing. We will get below 3 times in the next 12 months. And that obviously accelerates the path to get to that stable 2.5 times net debt to EBITDA. So that stated strategy and promise to the markets remains steadfast. The only thing which is changing is we are accelerating the timelines to get there. Now with that, what happens is a lot of our free cash over the next 3 to 4 years gets freed up for growth. And if we take some rough estimates, we believe we'll get some 1,000 odd crores of free cash over the next 3 years from our business. And that's now available for growth because our net debt is already at a level where we'll reach 2.5 times, if not lower than that, over the next 2 years. So we have a reasonable firepower. And to add to that, whenever we do an asset in upscale, GIC has an ability, subject to obviously them liking the deal, contributing incremental 35%. So I think what we are doing is we are really augmenting the firepower to grow the portfolio. And our focus is really growth because, as I said, and I'm sorry if I repeat it a few times, leverage is clearly sorted in this one single transaction.
With the partnership, GIC has got investments globally as well in other hotel companies, I think with Westin and a couple of others as well. You work with Marriott, of course, is the big one for you, but you have, I think, 3 international hotel flags in terms of, the multi-brand exposure that you have. Will we see more, and does that change in any way towards one or maybe addition of more?
We've always maintained a brand agnostic approach to investing. So in future, we will look at each hotel and each opportunity on its own merits. We are tracking many other hotel companies and brands that we like. And I'm quite sure that the bouquet of brands and the partners that we work with would expand in future.
Just very quickly, Ashish, before we let you go, this GIC deal that you've done, is it exclusive or you can tie up with others as well?
So on the upscale hotels, Nigel, it's exclusive. If we do any hotel in the upscale space, we need to take it to the joint venture first. But in the mid-scale, lower mid-scale space, there is no such exclusivity. But having said that, I'm personally not a big believer of exclusivity, but I'm a big believer of partnership. So as we've done partnership with GIC, we'd like to explore opportunities to grow this partnership, whether it is in contract or outside of the contract, because each partnership takes a lot of time to build trust and ability to do some things together. And obviously, once we've done that hard work, I'd like to believe both Sammy and GIC would like to leverage that hard work that we've done, the trust that we've built to do more and more.
Sure. So more partnerships like GIC?
Sorry?
Should we be expecting more partnerships like the one with GIC? Maybe in some of the mid-range hotels as well?
Not in an immediate way. Not in the immediate
Not in the immediate future. Got it, Ashish. Thank you very much. Very helpful conversation. Thank you for making us understand the structure of this deal, and good luck with those plans. We need to head into a very quick break now. Up next on the other side, the big auto discussion. The primary market will soon be buzzing with an EV IPO. It's a big one. What lies ahead? You're seeing some flashes right now on the Delhi EV policy on the screen as well. A full-blown discussion coming up with Hormaz Sorabji of Autocar India and Kumar Rakesh of BNP Paribas. Welcome back. So the market for the time being hasn't done too much, just about 50 points lower. The next sector on which we're putting the spotlight now is the automotive space. We all know that Ather is the next IPO in town. It'll be the first big IPO actually of the current financial year. It's all set to open for the general public next week. And for the anchor investors, it opens out on Friday. So what does this really spell for the EV sector in India, particularly, of course, EV two-wheelers? That's what we're looking to discuss with our next set of experts. Joining in are Hormaz Sorabji, editor at Autocar India, and Kumar Rakesh, India analyst, auto and IT at BNP Paribas. Gentlemen, thank you so much. Great to have you on. Thank you for joining in. Hormaz, I'm going to open with you because I go back to a conversation that we had on Ola. And this is well before the Ola stock price decline had started. And we were flagging off some concerns in terms of, after sales, the product itself and all. Short point is that Ola has been a pretty bitter experience from an investor standpoint. And on a separate note, there's all this going on with Blue Smart. So in general, in this environment, we have now Ather coming in, very different company. But what can investors expect? Will it be a little sweeter this time around?
I think for sure, I don't think you can paint both companies with the same brush. I mean, I've been very open about it. Ola, absolutely very, very poor credibility. I think just the way they've gone about it, I think they've taken investors for a ride is my view, just the way they've gone it. And, you've seen the reports, compliance issues, regulatory problems, very, very typical. My basic issue with Ola is that, from a technology standpoint, I've really not seen any breakthrough in what they've been doing. It's still the S1 Pro, which again is, a product which has come from Europe and adapted over here. I don't see any huge R&D capability in the company. I mean, the cells they are planning to make also as a 4680 cell. Is that suitable for a small scooter? I have my doubts on that. Whereas Ather, to me is actually far more refreshing, much more credible. They're sorted on their engineering. And, I actually have a lot of faith in that company. And so I said, you can't paint both with the same brush. So I think that's what investors also need to know, that, you have to, and obviously what's happened to Blue Smart, again, there are promoters and there are promoters. So they're not all cut from the same cloth.
Absolutely. Hormuz, but just one follow-up question. The only issue, again, purely from a market and investor standpoint, is that there is so much and such rapid, frequent policy change within EV, and that's always going to be a risk, right? Look at the lobbying that's happening in Delhi, and that was, I think, a source-based story that our colleagues in Delhi had just put out. The hybrid guys are now lobbying. They want hybrids to be given the same kind of treatment and perhaps incentives as EVs. So from a two-wheeler standpoint, since we're talking Ather right now, is there any policy uncertainty, regulatory issues, any such risks that investors should be very well aware of in the immediate future?
I think, the policy uncertainty, the fact that, policies are not defined well in advance. Again, this whole thing on CAFE, it's just been stretching. So I think that really is a big fundamental issue that, affects the entire industry, not just EVs, especially the ICE guys, because, emissions is a bigger issue for them and a bigger challenge for them, where it's not so much for the EVs. But you're right, I think these constant flip-flops between, especially at the state level, as you said, you've got road tax, once it's waived off, then it's come back on. So that does cause a lot of uncertainty. But I think, what's very clear is that EVs are the future. They will always have a huge fiscal benefit over ICE vehicles. And I think, especially with scooters, I think that's really been the segment that's led EV growth, because scooters lend themselves best to electrification. So I think that is the safest bet right now in the EV space. Of course, it's getting very competitive. You've got the legacy players also fighting back. Bajaj Auto, it's really kind of up the ante. TVS there as well. It's all come at the cost of Ola, which we've seen their market share has completely fallen. So it's not going to be easy for Ather either. You've got really strong legacy players in this game as well. But I think at least what I see is that, they've approached it right. Their fundamentals are right. Their products are good. And, they're not in this mad rush for massive volumes and growth and, a lot of smoke and mirrors, the way Ola has kind of, projected itself.
I mean, strong words, and always strong words.
That's why we like Hormuz. He cuts through the web.
Absolutely. By the way, Ather, guys, is like the poster child for incubation out of educational institutions. It's come out of the IIT Madras Research Park. So if you go down there, it's like a point of pride. Ather and what the founders, etc., have done with that company. Kumar, come into the conversation. I mean, as an analyst, what is your assessment of Ather? We've got the price band now. The RHP, of course, has been out there. We've been reporting on many of the details and they'll come up on the screen. But what is your sense? Ather.
Hi, good morning, Prashant. I'll not be able to speak specifically about the company, but I think what Hormuz was earlier saying, that in the two-wheeler space, especially in scooters, electrification seems to be a structural trend. It is the cost advantage customers have very well started appreciating. And that is something which we have seen over the last 2 years when the incentives have been coming down on the electric two-wheelers. The penetration falls for a month or two and then revives back up again. So, and then continues to grow. So that structural shift towards electrification in the two-wheeler space, we think is already pretty much underway, at least for the scooter segment. We'll have to see how much of success EVs can make in motorcycles. It would be relatively more complicated to electrify motorcycles at attractive price points. But at least we have enough and more headroom right now to electrify the entire scooter space. And that is where many of these new age startups are working. And some have started creating pretty good niche using their differentiated vertical integration and technology know-how. While the incumbents have definitely established the leadership, a couple of more Japanese players also will enter the electrification journey through this year, and we'll have to see how that redistributes the market share. But for the startups, the space would be really to create a niche for themselves, and technology is a good differentiator to create that niche.
All right. Hi, Kumar, Rakesh, and Hormuz. Thanks a lot for joining in. Well, Kumar, I wanted to ask you, there has been this talk that India is going to go a little bit easy on the duties, and then we'll have, the Harley-Davidsons and other US automobiles here in India. Do you think it is reducing duties, but actually we're not really giving away anything. Markets are very different. The left-hand, right-hand drive is very different. And maybe they don't make much of a dent. What's your take?
I think, yeah, I agree. Now, the incumbents in India who are selling are well established. The brand perception about the brands which are available in the markets are very well established. And now I wouldn't expect that to create a material impact on the existing structure of the market, partly also because of the price point at which these products will come potentially would be much above where the average price point in the market is. On the car side, the average price point is close to about 11-12 lakh rupees in India, which is significantly below the average price point what it is in Europe or US for that matter. And hence that may not create a lot of impact, and even more so in the two-wheeler space. The market in India is very different compared to US. And we have seen this in China as well. China earlier used to have a lot of restrictions in terms of global OEMs entering into the Chinese market. They necessarily need to have JVs and such restrictions. But when the electrification journey started, they reduced many of these restrictions. But what we have seen actually is Chinese OEMs are doing far, far better in the EV space now that they have established themselves. The customer and the market is well established. They are able to compete actually quite fiercely with these global OEMs in the Chinese market. And hence now we think we are way beyond the point where these domestic companies or the established companies could see a material impact from any new entrants.
Kumar, what are your top stock bets, auto OEMs?
So we prefer passenger vehicle names over two-wheeler industry. As we are discussing on this show, there's a lot of flux which will happen within the two-wheeler industry, the market share shift in the two-wheeler EV space. Some more entrants would be entering in the EV space, and that will continue to create impact on the ICE volume as well as margin of the overall business. And hence we see the passenger vehicle industry relatively more stable, where the bulk of the competition is within the existing incumbents and we don't have any disruption happening from outside. And also we would expect the long-term growth drivers to be very well in place for passenger vehicle industry. And that's why we prefer Maruti, Suzuki and Mahindra. Mahindra is delivering a pretty solid volume growth, and even their farm equipment business has been doing pretty solid.
Yeah.
So we would expect them to continue to deliver double-digit volume growth. Maruti, from a longer-term perspective, the points which you were earlier highlighting there, hybrid at some stage may start getting favorable policy support. Even without that, globally, we have seen hybrids to do much better than EVs in most of the markets, barring, say, China or UK. In UK, more for regulatory reasons, EVs have done better. But hybrid is the powertrain which has really picked up in the recent years, and India is behind in that curve. So we would expect at some stage hybrid in India also to start picking up, and the key beneficiary of that would be Maruti.
Got it. So Maruti, you like. M&M obviously has been the poster boy of the Indian automotive space from a financial market standpoint, which brings me to my final question to Hormaz as well. Hormaz, going back to passenger vehicles for a bit, you just heard the comments that Kumar made. The stocks, the companies, barring M&M, they've all been struggling just because of lack of growth, right? And against this backdrop, we have every day Mr. Elon Musk tweeting, saying that duties need to be lower. We don't know what finally that trade negotiation is going to be like. And I don't know if we can bring duties down to zero on an imported car. That would be almost unheard of in India before. But what should we be prepared for next 6 to 8 months on the PV side within this whole, Tesla knocking at India doors perspective?
Yeah. Well, I think firstly, you could have some serious reductions in duty, but they would be coming with conditions. It could be for a limited number of units. It could be above a certain price point. So I don't think, as Kumar says, it's going to really impact the kind of the core of the market. And over here, our cost structure is so strong, it's very difficult, for even, imports to compete with the lower duty if you try to go low down over there. But I think, the EV space, again, I think 2025 is going to be a very, very crucial year. Clearly, we've seen, let's say Mahindra, which has launched two vehicles, a bit of a measured start. I think they haven't really gone full tilt on it. I think they are, making sure things like the software and all are sorted before it reaches the hands of the customer. And I think you've got Maruti now coming in. We'll have to see what they do. It'll be very interesting. I think what Maruti will do will leverage its network, which is quite essential from an charging infra point of view. And that could be Maruti's play, not so much the product, but the EV ecosystem, which will, kind of be their play. Hyundai have launched the Creta EV. Again, a tepid response, really not as much as we thought, doing under 1,000 units a month. So, yeah, I mean, I think it's going to be very interesting in terms of how the EV segment plays out. But what's for sure, I think from a 2.5 penetration, it's going to be substantially higher. Best case situation would be perhaps, let's say 3.5 to 4%. But it's still, it's again, very, there's still a lot of barriers in the EV space. And I think infrastructure is primarily the largest one.
Okay. All right. Gentlemen, thank you very much. Very insightful discussion, very helpful one. And let's see what the next couple of weeks bring for the Indian automotive space, starting with, of course, this Ather IPO. Thank you for joining in this morning. Well, with that, let's head back to the market. Markets are absolutely fine. The Bank Nifty, actually, if anything, has recovered now from that opening cut of 0.5%. It's flattened out. We've got Mitesh joining in with some more details.
Well, that's right. I just want to highlight a couple of stocks. Whirlpool is now at the high point of the day. It's up 3.5%. Overnight, you had Whirlpool Corporation that came out with its set of numbers. They've given the Asia breakup. And the read-through from most analysts, and I have a sell-side note, they are stating that India is likely to have done well. Remember, the challenge is what the promoter is going to do with the India business, which is going to be important. But at least operationally, whenever Whirlpool India does report, it could be a pretty okay set of numbers. Could explain one of the reasons why the stock is up close to around 3.5%. But let's get back to Mitesh. Mitesh, what's your take of the initial 45 minutes of trade, and also give us a couple of picks?
Morning again. I think it's a market, which is just trying to consolidate. I think extremely overbought readings on the hourly to hourly chart suggest that there will be profit at higher levels. And I've been maintaining that on the index, if somebody wants to enter now, use declines to enter. So I think, wait it out. I think 24,100 and then 24,050 are good support pillars. I think that's where one can explore buying. Till then, keep your powder a bit dry on the index. But on stock side, a lot of stocks are still showing a tendency of moving up and are showing some kind of a breakout pattern. So I have a buy on Adani Energy Solutions. Keep a stop at about 935, which is today's low. Look for a target of around 980 to about 990 on the upside. And the other one is Sun Pharma. Pharma as a pack is doing well, and Sun Pharma yesterday had a breakout, today sideways, but the setup is positive. So I'll want to take a trading bet here. Keep a stop below levels of 1770 and look for a target of around 1845 to about 1850.
Okay, well, interesting ideas and trades. Mitesh, thank you very much for that. Well, let's bring in an exclusive conversation now. Tata Power is assessing opportunities for setting up large or modular nuclear plants, says Praveer Sinha, MD and CEO of the company, in an exclusive chat with my colleague Shireen Bhan. He also spoke about opportunities in the solar module space, capacity expansion there, and more. Listen in.
We've just seen the US impose tariffs to the tune of 3,500% on Southeast Asian countries when we talk about solar equipment. Now, does that open up an opportunity for a company like yours?
Well, it does open up opportunities for us, especially in terms of supplying these modules to not only US, but also to many countries globally. And that's an area that we are very seriously looking at, that how do we not only meet the requirements of solar modules in our country, but also export it and cater to the requirement of some of the other countries.
How much capacity would you have available at this point in time, which could be used for exports if that were to be the case?
Well, we today have a manufacturing facility of nearly 4.9 gigawatt. Most of it is actually tied up, but possibly up to 1 gigawatt we may be in a position to sell outside the country.
Would this also then perhaps accelerate capacity expansion plans?
Absolutely. We are examining that now that we have commissioned our 4.3 gigawatt plant, the solar cell and module plant in Tamil Nadu. We strongly believe that we have a capability to execute projects very fast and ramp them to full production. So we are definitely examining such opportunities. And based on how the market conditions are there and how some of the things that will evolve globally,
we'll take a call on adding capacity.
And do you believe that this call is likely to be taken sooner? Are we talking a few weeks, a few months?
Maybe in few months.
In a few months. Well, again, speaking about the opportunities that you are considering at this point in time, and you brought up the issue of nuclear power, and that's a move that India has now decided to further. In fact, the finance minister made the announcement of amending the liability clause, and there seems now to be a concerted attempt by the government to move down that path. What does it mean for Tata Power, and what does it also mean for India?
I think in the energy transition, one of the gaps that we had was we need to have a very efficient base load generation, and nuclear fulfills that requirement. Government has very timely taken a decision that they will open up for private sector, and the government plan is that we will have at least 100 units of SMRs by 2047, which I think is a right move and a correct move given the huge growth of power that is there in the country. The important thing is that this will also bring the best technology which is available globally, as also Indian technology. We have the Bharat Small Modular Reactor, and that is something that we can start with and then get some of the newer technologies from other parts of the world. And for Tata Power, this is an opportunity that we are looking at. We are identifying places, locations in the country where it is safe to put such large or modular nuclear reactors. And I think we'll play a very important role in the whole opening up of the nuclear reactors in the country. And I think you will find that going forward, we'll set up a few plants.
Well, you've made it very clear that you do intend to get into this space and set up a few plants. Of course, the legislative action will take its own course, but how ready and prepared are you at this point in time to move forward on these plans? You said that the process of identification has begun. So realistically, what are we talking about in terms of timelines? As and when the legislation, of course, gets through.
So typically, it takes about 2 years to get the land and get the necessary approvals, permits from various government bodies, statutory authorities. So we are looking that maybe 2 years hence, we would be in a position to start work on construction. Typically, these type of projects take 4 to 5 years for construction. And we do expect that we will be in a position to be ready with the plant sometime in early part of 2030s.
Sometime in the early part of 2030s. But, again, for the benefit of all of our viewers who are watching, what does it take to set up an SMR? You were talking about technology, you were talking about indigenous technology as well. What are going to be some of the challenges that one will have to contend with, to be able to make this a reality?
So the most important part of it is how do we make them safe and secure for operation. The nuclear island, which is the main heart of the plant, is something that has to be constructed. We do have a large number of companies in India who make these type of equipments, and we need to put that together and give them the confidence that large number of nuclear plants will come up. So to that extent, we need to get them organized to cater to the requirement of the private sector. The second is the power island, which is like the normal turbine, and those are very well known, and the balance of the plant. So I don't think there would be really a great challenge if we have a good technology partner. In India, we have the Nuclear Power Corporation, which has the right technology and also the competence to support in setting up these type of plants. But globally also, there are large number of companies.
Westinghouse?
Yeah, absolutely. And then there are the French companies. And
are you in talks with anyone at this point in time?
Well, yeah, we keep on discussing with them because technology is something which is evolving very fast. And it's very important to keep ourselves abreast with what's happening globally. So we are very excited about the opportunity. This is a new way in which we can produce clean power. And I think we will have large number of them, not only setting up these type of plants in remote locations, but also in locations where we have the load, and we will be in a position to set up and operate in a very, very safe manner.
What would the capex be for an SMR typically?
Well, the capex is very large. A normal coal-based plant costs about 8 to 9 crores. This will be double of that. But the cost of uranium or the fuel that you use in nuclear plants is much lower. Of course, the whole tie-up of getting the fuel, the processing of that fuel, the spent fuel that has to be taken away, all that has to be done by a government agency. We need more clarity on that in terms of how the government will set up a separate entity which will support the power companies, which will set up these SMRs. So I think there's a whole lot of work that needs to be done, but I personally feel that the cost of power from nuclear will be as competitive as the cost of any other firm power that comes, whether it is from brown coal or it is from any other way that we produce 24/7 power.
All right, that is Tata Power. Let's quickly move on and focus on some of the other stocks that are on the move. We have Vinny standing by, who's tracking Syngene and Divi's. Vinny.
Hi, morning. So yes, keeping an eye on both these stocks today. Divi's, firstly, it's on the back of a brokerage note. Citi has given a buy rating. Target price is what they've increased. 7,050 rupees from previous target price of 6,850 rupees. Now, why? Because they believe Divi's has a high potential to become the primary supplier to Eli Lilly's oral drug, which we had recently heard that, phase 3 trials, the trials that were going on were quite efficient. So on the back of that, they believe that Divi's has a high chance versus competition to actually become the primary supplier. Why do they believe so? Because the Divi's has a lot of capacity that is there as well. They're focusing a lot in terms of capacity addition as well. Current capacity 300 metric tons is there. Planned capacity is also there for the company. And because of this, Citi believes that Divi's has an opportunity actually and forecasted around $800 million plus GLP-1 opportunities coming in terms of revenues for Divi's by 2030 is the estimate, and Divi's continues to be the top pick. Now, on the other hand, Syngene, why we are keeping an eye out on this one? Because they've reported their numbers. A weak set of numbers came in from the company in Q4 FY25. Overall, other than that, what is also there is that FY26 guidance. That's not exciting, and that's not something that is exciting the street as well, because FY25, they believe the revenue will be much lower in terms of single-digit revenue growth is what they're saying, and other inflows in terms of EBITDA and margin also, they expect that to also come back.
Okay, all right. Vinny, thank you very much for that. We'll come back to you for a sort of more detailed link, but Lever numbers, HUL numbers are out. Usually Lever reports later in the day, but the numbers are out in the morning, the first half. When the first hour of market open, they're looking like they are in line, largely in line to slightly lower. Actually, I think on the EBITDA and PAT level, they seem to be slightly lower. Margins 22.8 compared to 23.1. We don't have the volume growth, which we should be able to get soon. And Mangalam is miking up as we speak, and we should be able to go across to him. The top line numbers should also come up. I think that table with the top line and the bottom line numbers, etc., will give you a quick snapshot view of the actuals are compared to the poll. So, is there a big surprise? Maybe at the margin, if you want to be, maybe you want to nitpick, maybe at the margin, at the bottom line level, slightly on the downside. But stocks holding up about 1% for now. Numbers just about coming in. Mangalam, what do you make of the numbers?
These are absolutely in line with what the street was expecting. No quibbling about the margins or the EBITDA as well. The company has reported a revenue of 15,200 crores. What was the street working with? 15,161 crores. So when you're working with a base of over 15,000 crore, a 40 crore miss is nothing really to write home about. The EBITDA 3466 crores, growing slightly lower than street expectations of 2% by growing 1%, but that also was expected because of the firm inflation that we've seen in tea prices as well as palm oil prices. I'm just trying to figure out what the underlying volume growth is this time around, but my sense is it's not going to be much beyond what the street was expecting, which was either flat to 1%. Why do I say that? Because the revenue growth has been around 2%, which is largely in line with the price growth that the company has made as well. Net profit growing at 3.6%, again in line with street expectations of close to around 3% growth itself. What is it that the company's done in their segments? Home care segment has been around 5,800 crores. The street was working with a number of around 0 to 3% in terms of growth coming in out there. Foods is where there has been a revenue decline as against a revenue growth expectation. So that's something that we'll most definitely keep an eye out on. Perhaps it's on account of, the decline in tea volumes despite the rises in tea prices. And that's largely because, at higher inflation levels for tea, people move to unbranded tea. So there is a lot of, down trading that takes place out there. Still awaiting volume growth. Nothing yet. But these numbers, largely in line with muted expectations. And on Prashant's comment of them having reported their numbers in the first half itself, I did speak to the management about this. They said from here on, Hindustan Unilever will report their numbers at this hour itself. This is to be in line with the Unilever parent reporting their numbers. Typically, the Unilever, international report numbers come in at around 7:30 to 8 a.m. UK time. So comparing with that, the Unilever India numbers will also come at that time itself. This is perhaps to prevent the arbitrage that takes place between Unilever reporting numbers, their India commentary, and thereafter the Indian numbers coming in at around 3:30 for itself. So from here on, we have to brace ourselves for Unilever reporting their numbers.
Mangalam?
The interaction is at 11:15, so I'll be rushing to Andheri right from here. Meanwhile, we do have Prakash Diwan joining in as well. Prakash, 2% revenue growth, 1% in terms of EBITDA growth, volumes largely flattish. Do you think this is the bottom of the barrel right now, and from here on things can only improve, or maybe just stay put because growth is not coming by any time in the hurry?
No, looks like we are probably at the bottom, Mangalam. The reason being the numbers could have been much more softer than what they are. If you look at this particular quarter, in spite of whatever, higher food, we have a receding food inflation environment, and that is something which you could look forward to in the subsequent quarters. With the quarter gone by, I don't think there was any way margins could have been better or revenue could have been. But there's not much of pricing power left after all the grammage changes that most of these larger players have done. My sense is this is close to the bottom, if not the bottom. But the street will like if the commentary is sounding positive on some of these segments that could start picking up. I don't see any reason why it would not form a good bottom and give you an opportunity to participate in the upside.
All right, we're still awaiting management commentary from Unilever. Typically, it comes shortly after the earnings release itself. So we'll await, any sort of comments on the demand environment and, more importantly, what the underlying volume growth has been this time around. But the stock's not giving up because, of course, it's been an underperformer, still trading very close to its 5-year average valuations itself. Amnish, the same question to you. The stock is trading at closer to 5-year, average valuations. It's not done much in terms of a performance when it comes to growth and the stock price move. But from here on, do you think things should improve, or maybe you'll, let that be right now for Unilever in terms of a call?
Okay, these expectations are not very high. And with the inflation having peaked out and the volume recovery overall in the sector likely to be better in the coming quarters. And I think the HUL from the current perspective can give you a reasonably good trade. Say from 21,200 rupees, where it was earlier trading at. Now it is close to 24. But if you look at the last 12 months, it is still significantly below its peak, which was around 3,000 rupees. So I believe that from the current level, there is a probability for the stock to give you a reasonable 10 to 15% return if the volume growth picks up as expected in the industry. But in terms of margins and all, one should keep the expectations moderate because the focus, I think, is going to be on the volume growth going forward.
No, I remember speaking to one of the analysts earlier on the program. They were saying that you can't fault these companies at least for the dividend yield, right? Yeah. The final dividend is 24 bucks. Put all the other interim dividends put together. In a year, HUL has given you 54 rupees in your hand on the stock price. At least that you can't fault them for.
It's about 2% on the stock price itself right now. Be that as it may, 2% revenue growth. It's actually not about the margins. It's definitely not about, the earnings, etc. It's just about growth, which has been fairly anemic. And it's not that 0 to 1% volume growth has been, on a very high base or something. If you look at the trend over the last four or five quarters, it's never exceeded 3% at best. So even if you look at a CAGR over the last 2 or 3 years itself, the volume growth has been just about 2 to 3% at best. So on the back of that, there really is weakness in the external environment, as the managements have been pointing out. But lately, the question is, what is it that HUL is doing internally to pump prime the growth in the near term as well as the long term? To that, they have laid out a strategy at the Capital Markets Day as well, saying that they're looking at 6 verticals of growth, beauty and personal care being one, face, high-end sunscreen, etc. being the other, and then you have nutrition and well-being as well. From a management change standpoint as well, very recently they hired Rajneet Kohli from Britannia to head their foods business. One of the rarest lateral hirings done by HUL. Typically, you have HUL managers going and leading other companies, but here you have Rajneet coming in from Britannia and leading their food business. So what their expectations are. The thing is that with all these changes that the company has been making, Rohit Java has been there for about a year or so. Is this the time where the stock is at an inflection point? Very recently, we had a note that came in from UBS as well, which did say that HUL and GCPL look like stocks at inflection points. That's the question, because when the results are so muted and the stock is still up around 1.5%, that tells you something.
If you talk to, I've not spoken to many, but I've spoken to one or two HUL sort of insiders, past and present, and they all make the point that all these newer brands, D2C, etc., they've been chipping away in some of these fast-growing categories. Skincare, I think, sunscreen as a brand.
Which is why HUL took the fight right to the heart of the matter, right? I mean, I don't remember HUL being in so much press for legal issues as with the sunscreen ad.
Just one. So this person, the one comment stayed with me. He said, "Well, the R&D of HUL is a very large organization. Large organizations typically take a little bit more time to respond, react, etc. But the R&D within HUL, the product lineups, etc., is so vast, and when that gets going." I mean, they can really sort of charge ahead in some of these categories. To that point of inflection, we'll see.
Totally. I can just tell you one thing about this. In all the other categories, you have the disruptors going ahead and acquiring the incumbents, be it financials, be it, technology and all of that and stuff. It is only in the consumer space where it is the incumbents which go ahead and acquire D2C companies. Why is that? Because that's where the power lies. D2C companies, 0 to 100 crore, very easy to scale. 100 to 500 crores, a little difficult. 500 to 1,000 crores, a little tough after that. Beyond 1,000 crores, you have to be with these big boys. So over the last 6 decades that HUL has been here, every decade there has been a disruptor or two which has nibbled away at their market share. But at the end of the decade, the disruptor wasn't there. So if it's the long-term game, then it is HUL. Near-term, of course, it's 1-2% growth that it does anemically. But it's built up a 15,000 crore revenue base per quarter sort of target.
It's an absolute giant. Mangalam, thank you very much for that. 1.5% higher on Lever. The numbers, of course, coming through, and of course, the numbers will now quarterly numbers every quarter in the mornings instead of later post-market close as it was till the last one. Well, we'll take a quick commercial break here. A special segment. It's the economy. Lata in conversation with Stephen Major, the fixed income expert at HSBC, on expected trends in what else but global macros, dollar, Indian yields in focus. Stay tuned.
Hello and welcome to It's the Economy. The latest statements from the United States administration appear to signal a thaw. President Trump has said he has no intention to fire Fed Chair Jerome Powell, and Trump and Treasury Secretary Scott Bessent appear to be signaling some de-escalation in the trade war with China as well. However, we haven't seen a very big bounce in US Treasury yields, though equity and gold markets are reacting very strongly. All other risk markets are reacting very strongly. To understand what's worrying, what's moving the debt and currency markets, I have with me an absolute veteran of the fixed income markets, Stephen Major, Global Head of Fixed Income Research at HSBC. Stephen, thank you very much indeed for your time today. Well, actually, while I express my sympathies for all fixed income traders, given the hot, cold, blow hot, blow cold statements you all have to deal with, what is the underlying worry of the US yields? Why is it just refusing to go below that 4% mark, which we did see on April 2nd?
Well, in fact, there's a story here of a different narrative really behind the front end compared to the 10-year. The front end looks like it's quite rational in that it's pricing in rate cuts and doing exactly what you'd expect from weaker growth and trying to look through the tariffs and the inflation that might come near term. The 10-year is a bit more vulnerable to global factors and uncertainty combined with volatility. And I'll just emphasize that point because uncertainty in its purest form would be good for government bonds because it results in deferred consumption and investment, lower GDP and lower policy rates. But when you add volatility, investors require compensation. And that comes in the form of additional yield and a steeper curve. And that's the reason that 10-year bonds are lagging the performance of 2 years. But let's not forget, 10-year yields are down since the peaks around the 13th of January before the inauguration.
Oh, no, that's a fair point. They had touched, I think, 4.78 earlier this year, as you say, January. And it's clearly fallen, but we were expecting sub-4 recession fears. Let me ask you about this conspiracy theory. There are people who say that Japanese investors have been selling. Some people are even proving it with numbers. Conspiracy theory of Chinese and Japanese selling. What's your take?
Yeah, so look, on the first point about what the view was, the consensus view at the end of last year was that 10-year yields were going to go to 5. And so the surprise was that we were heading to 4. The surprise on top of the surprise is that we're at 4.4, 4.5. Now, the overseas selling argument comes and goes. The latest data has suggested that Japanese sellers were there of a magnitude of $20 billion in the recent week. And I guess it's a rational outcome from the news flow that some private investors may choose to de-risk or to take money away from the US. But $20 billion, let's put this in perspective. The Treasury market turns over between $1 and $1.5 trillion per day. It has a $29 trillion free float of marketable securities. $20 billion is a drop in the bucket. It isn't even a quarter of a typical auction size. So I push back on this idea that overseas sellers are driving the yield upwards because, first of all, the yield hasn't gone up. It just simply hasn't fallen as much as some people have recently started to expect.
Okay. Fair point. Okay, rather than ask you to defend somebody else's actions, what's your own expectation? What are you expecting by way of Jerome Powell's actions, Fed actions? And what are you therefore expecting on the 10-year through the course of the year?
Yeah, so we have a forecast of 3.5% for the 10-year Treasury. We have an official forecast of 3 rate cuts through the rest of this year and then 2 more next year. The forecasts have not changed. Our 3.5% forecast for the end of 2025, we've had it since the middle of last year. the point is the forecast is the forecast. It's based on scenario analysis, not a simple point estimate process. So to me, when our economist tells me that he thinks the Fed could cut 3 more times this year, I think, well, yes, that's consistent with the Fed's own projections, but also from a more stochastic or probability-based framework, it's a bit like saying there's a 50% chance that they cut by 6 times and 50% chance they don't cut at all. To me, there's an asymmetric bias to what happens here to the bond yields. The bond yields are unlikely to go up very much. I don't think the 10-year will break above 4.5. When the 10-year hit 5% last year sometime, the policy rate was 100 basis points higher. So with policy rates where they are now and expectations of easing, it's very hard, I think, for the 10-year to go above 4.5. And once the easing starts in the second half of the year, I think we'll be on the path towards a 3 handle and maybe as low as 3.5 as per our forecast.
Okay. Well, let me try and counter this argument just to, try out these contrary arguments. There are people who worry that if the US is working towards reducing its trade deficit with every country, probably even go to a surplus, I don't know, but at least definitely reduce trade deficit, all of us, like India, China, Japan, will all have fewer dollars. There will be fewer reasons to buy US treasuries. So will not that push up yields?
Yeah, so you're touching on the accounting identity that speaks through the trade deficit, current account deficit, and capital account. Yeah. So someone probably needs to explain that to the powers that be in the US, because it doesn't make a lot of sense to many economists. The thing is that the bonds are increasingly being bought by domestic investors. Some 70 to 75%, depending on how you calculate, of the bonds are inside the US, either in the private sector hands or inside the Fed. And that trend will probably continue so that there's even more. And if you look back through long periods of history, whenever there's a recession, domestic ownership actually picks up.
Yeah.
So I'm not that worried about the bond market. I think that the dollar was overvalued. It was very hot coming into the start of the early part of this year. And so some of the dollar move is actually mean reversion. If you look at the dollar versus most indices and individual currencies, it was overvalued. So some of this is a mean reversion. Some of it is cyclical. And there will be people that tell you there's a secular story about de-dollarization. We would push back against that one as well.
Okay. Yeah, even I find it difficult to believe the de-dollarization story. At least there is no alternative. But Stephen Major, since we have started the conversation into dollar, can you give us your expected range? Are we going to see the dollar index, the DXY, below 100 for a better part of the year?
Well, we've already fallen a significant amount, a double-figure amount. And it wouldn't be unreasonable if we fell a bit more from here. And you know, the possibility of 5 to 10% is quite possible. I've got a few simple rules of thumb in my head. If you took, say, one of the major parities like euro-dollar, since the euro was created, the euro versus the dollar has been in a range of 0.8 to 1.6. So the midpoint is 1.2. And 1.2 isn't that far from purchasing power parity, apparently. So the fact that the euro's going up and the dollar's going down, again, seems to me fairly consistent. And globally, it looks to me a logical outcome that the dollar should be a bit weaker. Now, the FX markets go through regime shifts, and for much of the last few years, it's been very cyclical. So whilst the US economy was running hot and US real rates and policy rates were higher than everyone else, the dollar was winning with this rate differential argument. But this is too simplistic, because what happens is the FX market can switch very quickly into a different regime, and it could be more structural or, at the moment, more political, because the tariffs really are embroiled in politics, and therefore some of the dollar move will be explained from a more of a political framework for the currency market than a cyclical one.
Fair point. Okay, let me come back to my favorite topic, the bonds. We are seeing contrary moves. The US yields have been high, or at least are not falling, but other yields have been falling, especially in Asia. Can this disconnect continue?
The short answer is yes, and a softer dollar helps the Asian central banks that want to be on an easing path and can justify being on an easing path because of their local domestic data and backdrops. So a softer dollar is consistent with that. What we don't want to see for the Asian markets and actually more globally into some of the emerging markets, we don't want to see a fast move because that would normally be associated with dysfunction or a hard landing. Now, a hard landing may be what we eventually get. A lot depends on the news flow around the tariffs, which of course could change whilst we're speaking. But the reality is, this backdrop does open the door for easing by Asian central banks, and perhaps more than is expected in the forwards and in the consensus expectations.
What's your best Asian market? And per se, your comment on India itself. We have seen a dramatic fall in yields. Is there more to come? Would you be attracted to this market?
Well, our forecast is 6%. We think there's 2 more rate cuts this year. I think that the nature of the momentum that's building up is that we could be underestimating how far yields are going to fall. So if I think there's a risk to our forecast, it's that we're not bullish enough. If I have a look-back bias through our recommendations this last year, we've been consistently bullish on India. It's been one of our favorite markets, but I always feel we haven't been bullish enough. The arguments for buying India have been based on diversification, and then what is on a relative and absolute basis a strong and stable government with a negative fiscal impulse, a genuinely good, happy outlook. What I fear is that this view is becoming quite consensus. And as a fixed income analyst, I prefer sometimes to be a bit more lonely with my views.
Stephen Major, it's been a pleasure speaking with you. Thank you very much indeed for joining us. And of course, the key takeaway from Stephen Major is going to be that he sees Indian 10-year at 6% and one of the more attractive fixed income instruments in Asia. Thank you very much for watching this edition of It's the Economy. Time for a break. Chartbusters coming up.
Hi, sir. Mangalam here. How are you? With me is Nigel currently. Hello?
Yeah.
Hi, sir. This is Mangalam here. With me is Nigel. Can you hear us?
Hi, Mangalam. I can hear you loud and clear.
Perfect. So just a request. I have to rush for the Unilever press conference in exactly 10 minutes. So crisp answers, a lot that the street wants from you. Growth outlook for this year in quantifiable numbers, and outlook for Nourishco and Capital Foods and Organic India with margins as well.
Yeah.
We'll ask you for specific targets, sir. Thank you so much.
Hi, Mr. D'Souza. Good to speak to you, sir. This is Nigel D'Souza.
Hi, Nigel.
Always good to hear you. So we'll buddy up with Mangalam and put in a few questions to you.
Sure. There are no headlines. No, I know. HUL and Tata Consumer report largely in line set of fourth quarter numbers. HUL gains with volume of about 2% in terms of growth. Tata Consumer slips as gross margins contract 420 basis points from a year ago, and the stock had already seen a bit of a run-up. In fact, we have the management of Tata Consumer joining us very shortly to discuss their numbers in detail.
Syngene shares fall as much as 10% after reporting a revenue miss in the fourth quarter. A mid-single-digit growth guidance for FY26 also leaves the street disappointed.
Persistent Systems climbs 2% on the back of a strong quarter. Constant currency revenue growth beats estimates. Margins improve. The company has also maintained its guidance for FY27.
Singapore's GIC will pick up 35% stake in Sami Hotel subsidiaries for around 750 crores. The management tells CNBC TV18 the deal significantly reduces its debt and frees cash for growth. The stock is up by 7%.
Rallis slips nearly 5% following a weak quarter. The revenue declines 1.5% from a year ago. Pressure on export volumes and margins were major drags on the company's fourth quarter performance. You're watching us here on Chartbusters. I'm Mangalam Malu. With me, as always, Nigel D'Souza. It's earnings season, so let's get in our first management coming in on the show. We come to you live from the CNBC TV18 Motilal Oswal studio. It's Tata Consumer, which reported a largely in line set of numbers in the fourth quarter. The EBITDA beat estimates despite gross margins compressing by 420 basis points. We have with us Sunil D'Souza, who's the MD and CEO of the company. Thanks a lot, Mr. D'Souza, for joining in right now. The most important thing that the street wants to know this time around for the next 1 year is what is your target on the margins? You've said that if tea prices were to normalize, you could see margins normalize as well. The question is, what is that normalized level? And secondly, what's your expected target for Narishko, Capital Foods and Organic India in FY26? These three numbers, if you could provide us.
So Mangalam, we had a good quarter in line with our expectations, actually slightly ahead of expectations. As to your question on forecast for FY26, double-digit revenue growth is a given. We've already come to volume growth across all our businesses this quarter. We have every single business growing on revenue as well, 17% top line, 12% organic. EBITDA margins were a bit soft. And if you look at it, overall EBITDA, I was a negative 1.1. But here's the thing. The primary compression has been because of tea prices, which have run up 25 to 30%. We've absorbed about 50% and passed on about 50% of the prices. So two things are going to happen. A is we're going to continue to take calibrated price increases as we go forward. But also as the new crop comes in, if it is normal, we expect tea prices to start coming down. That will aid margins. Just as a perspective, while we say margins are going to improve, if I took off both the cost and price increases that we took on tea this quarter, I have improved my full year by 80 bips. Our guidance is for improvement of 50 to 100 bips every year on EBITDA margins, and that doesn't change. As regard the question of starting with Narishko, about a year back, we had pressure from competitors who went in with significantly higher retail margins. No changes on consumer price, which was 10 rupees in Tata Gluco Plus. And we had to recalibrate our retail margins. We did that. And we rejigged our distribution system, etc., to the new reality. And it's coming back very strongly. Actually, we exited March at a 38% volume, 26% revenue. And for the quarter, it was 17% volume, 10% revenue. So it's back on growth. We do expect it to come to 30%. And there's no reason why. The Himalayan business, which is premium, grew by 29%. And the Tata Copper, our water business, grew by 23%. So largely on track. As regards Capital Foods and Organic India, the good part is we finished the integration. We've taken synergies out. We understood the business. And I would underline that because it took us about 4 to 5 months to understand the nuances of the two businesses. Different product, different buying cycles, procurement, supply chains, marketing. And now I think we are in full control. This quarter, I think we delivered some decent numbers, 213 crores of Capital Foods, 109 on Organic India. Actually, if you take growth rates, it's 80 and 40 plus in the two businesses, but that's because we had soft quarters last year in Q4. But we feel pretty confident of delivering 30% growth going forward with a focus on distribution expansion and innovation and portfolio expansion as well.
Okay. Hi, Mr. D'Souza. Good morning and good to see you. Ben, I wanted a couple of other points. On the international business, what kind of a growth are you guiding for? On a blended basis, last year's growth was better than what the street was working with. So that's good. For this year, what will international business look like? And what is the targeted ROE? You know, it's still in the mid-single digits. So where do you see that headed?
So the international business, the good part was for the full year, I think we delivered a 5% top line and a 21% EBIT growth. And broadly, the business is back on track. We've always maintained a mid-single digit top line and EBIT margins being accretive to India, accretive to our total business. We did deliver a 5% growth and EBIT margins were 300 bips higher than where we delivered the rest of the business to be. So it's fulfilling what it's supposed to be. The UK business is a standout. We're number 2 tea business now and on a very strong margin profile and overall structural balance. Canada, of course, has come back. It's always the jewel in the crown, very steady. This thing. The US business was a bit of topsy-turvy with the coffee prices, etc. I think that's come back on track. We had 2% volume, 4% revenue growth, and we've announced a price increase starting June with the coffee prices, and therefore even the margins will come back. So international business, again, mid-single digit top line and EBIT margins accretive to the total business is what we would guide for. On the ROE basis, it's a choice to make. I could stand still on acquisitions, and therefore, as I grow my top line and EBITDA ahead of margins, I will improve EBITDA, my ROE, ROC margins. In fact, before we did the acquisitions, if I'm not mistaken, in 4 years, we had gone up about 400 to 500 bips on ROC. So we could do that. But we are geared for the longer term. We will grow organically and inorganically while making sure we are focused on both top line and profitability.
All right, we take that point. And final question before we let you go, Mr. D'Souza. One is the target share of revenue that you expect from new products. You launched 41 in the last financial year, 41 in the previous financial year as well. So what proportion of your revenue is currently coming from products launched in the last 2 years? What's the target here? And secondly, there is a slowdown in Tata Starbucks. Do you still maintain targets of 1,000 stores? And have you scaled back on the pace at which you are investing in Tata Starbucks? Comment on Tata Starbucks as well as innovation in products.
So on innovation in products, Mangalam, innovation is key to any FMCG business. And we do aim to be in the top tier of innovation in the food and beverage and FMCG space. Last year, FY24, we delivered 5% plus. FY25, we delivered 5.2. We aim to continue that same trajectory going forward. So you could expect one launch every week as we go forward. That doesn't change. In fact, we will try and accelerate that, if anything. On the Starbucks business, we remain focused on the long-term guidance of 1,000 outlets by FY28 doesn't change. We remain committed to that. It's just that I think I said this earlier also, we will calibrate depending on market conditions. The simple thing that I use is a quote from one of my bosses earlier. Emerging markets is a snake in a pipe. Directionally, it's going up, but it will yo-yo up and down while moving up in that direction. And that's where we are. The good part is I think we've started to see business coming back a bit. Same-store sales growth was, I would say, low double-digit negative when we started off FY25. By the time we exited the quarter, we are into almost zero, touching distance of zero on same-store sales growth. We had tempered outlets a bit, but we remain confident of hitting the 1,000 outlets by FY28.
Okay, all right, Mr. D'Souza. Appreciate you joining in. Thanks a lot for giving us those details. We look forward to having a chat with you as the year progresses. For the time being, we'll take that guidance on board. The stock is down close to around 1.5%, but actually it's recovered considerably from the low point of the day. Well, let's slip into a short break. When we come back, we'll focus on the technicals of the market. Sachidanand Uttekar will be joining in. Welcome back. We'll keep an eye out on a few stocks on the screen. VIP, yesterday the stock had seen a good recovery from the low point of the day. That one has continued with that, so volume spike on that one. And the other stock that's surging away, which we pointed out earlier as well, is Whirlpool. Now it's up close to around 5.5%. The international parent, that's Whirlpool Corporation, came out with its set of numbers. And the read-through is that India business could have done quite well. So that's the reason why that one is up close to around 5.5%. And Dalmia Bharat continues to hold strong with a gain of close to around 3.5%. Sachidanand Utekar joins us on the show. Hi, Sachi. Good morning. Good to see you. When markets in a bit of a consolidated mode just for yesterday as well as today, moving in that band of around 24,000 to around 24,350 or thereabouts. How would you read this? Would you look to buy into this mild dip?
Good morning, Nigel. Good morning, Mangalam. I think clearly the trend has been on the bullish side. What we are observing today is a mild consolidation. And as you rightly said, I think 24,200, 240 looks like a stable base. But on the higher side, there is resistance at 24,440 at least for the day. But overall, we are expecting that this particular rally should continue towards 24,500, 560 in the coming weeks. So I think it's better to be on the long side. The decline is very healthy so far. That 24,240 mark has been respected well. So keeping a stop loss somewhere close to around 24,160 on a closing basis, some long positions can be maintained. When we look at Nifty Bank as well, 55,000 support has been very strong and very significant. Even here, until unless we don't see a closing below the 5-day or the 5-day exponential moving average support, which is placed somewhere close to around 54,960 thereabouts. I think the trend momentum would still continue to be on the positive side. So even Nifty Bank, I think, has come to a stage wherein some long positions can be deployed. We are expecting that in the coming series, Nifty Bank may scale towards 57,000, 57,300. When we look at stocks, there are ample of stocks which are hitting our radar now. If you look at Tata Power, this is something wherein the stock has started trending above its 200-day exponential moving average after almost 4 months. If you look at its 50-week exponential moving average support, which was placed at around 388, has been negotiated well. And if you look at the weekly RSI, it has started giving a breakout above that 50 mark. Even on the price scale, it looks like a inverse head and shoulder formation, exhibiting a pattern target at around 436, and that's why we are recommending building long positions for the coming series. Trading target is placed somewhere close to around 412. Second target would be 436. The stop loss can be placed at around 388 on a closing basis, and long positions can be deployed in Tata Power. The second stock which has hit our radar is Cipla. Now, the entire pharma pack has been doing really well. We have already seen very sharp pullback moves here. But if you look at Cipla's performance for the last couple of trading sessions, we have seen consistent built up on the long side. If you look at the weekly pattern, it looks like a classic V pattern breakout. Even here, the daily ADX has just turned on the positive side. It's giving a breakout at around 25 level, which is a good sign of momentum. So we are expecting that this particular move may extend towards 1600, followed by 1670. And that's why we are recommending building long positions in Cipla in the May futures. One should keep a stop loss at around 1540 on a closing basis.
Okay. All right. Thanks a lot for that, Sachidanand. Well, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk about a stock that he's tracking closely. Sachin?
Maharashtra-based country liquor manufacturer GM Breweries posted a solid operational performance in the final quarter of FY25. In Q4 of FY25, the company reported a top line of almost 169 crores, which represents a growth of 6% year-on-year. Margins also expanded by 60 basis points at the operating level to 24.5% in the quarter gone by, thanks to benign operating costs. However, the operating costs, especially on the raw material front, is expected to be challenging going into FY26 due to decline in sugar production at the all India level. The sugarcane production in India is anticipated to decline almost 20% year-on-year due to unfavorable weather conditions. So that should have a bearing on the margins for the company going into FY26. That being said, the company has a very strong balance sheet to navigate the current set of headwinds and is currently sitting on cash equivalents almost 600 crores. And also the company trades at reasonable valuation of around 10 times FY26 estimated earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
All right, well, let's slip into a short break. You come back, we'll continue to focus on markets and stocks that are moving around. Well, let's address another story that's coming in. Sources tell CNBC TV18 that the Indian Commerce Ministry officials will be visiting the US, UK and other major trade partners to discuss the terms of the FTA. Abhimanyu joins us, all those latest details. Abhimanyu?
Global trade will continue to remain in focus as several Indian officials are going to visit various countries in the next few days, ranging from the United States to the European Union, the United Kingdom, and even an EFTA country. Now, an Indian negotiating team led by Chief Negotiator Rajesh Agrawal, who's an additional secretary with the Department of Commerce, is already in the United States, and they are going to hold talks with the American side before formally launching negotiations for a bilateral trade agreement between both the countries. Now, already the terms of reference have been finalized with 19 chapters, which include issues like goods, rules of origin and regulations. It remains to be seen how talks are going to pan out. Also, Piyush Goyal, India's Commerce and Industry Minister, is going to leave for a 5-day visit on the 27th of April. He's slated to go to London, Oslo and Brussels, while India is already engaged in FTA negotiations with EU and the UK. It's awaiting implementation of the FTA, which India had signed with EFTA countries, since it has to be ratified by respective parliaments of different member countries before it completely gets implemented. Also, the 11th round of India-EU FTA talks are slated to be held in New Delhi from the 12th to the 16th of May, and an Indian team is expected to also go to Brussels next week for pre-negotiation talks with the European Union. Now, both the sides may explore the possibility of an early harvest agreement similar to what India had signed with Australia.
Thanks a lot for that, Abhimanyu. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I went in chappal, and as a student you go there and so kala come to and so on, and then after conviction, after some convincing, fill the form. 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was like you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, like, you know, in like low single digits. And now it is at like high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do like e-commerce, unregulated products. We will not do anything which is not good for the customer.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar, and with me is Vinny Motiwala. And after 7 good days on the trot where the markets were running higher and higher, today is a session of consolidation. Markets have paused. The Nifty is down 50 points, just shy of the 24,300 mark. The Sensex has slipped 180 points. Mid-caps, though, continue with their relative outperformance. So no gain on the mid-cap index. The mid-cap index is flat. But this week, the mid-cap index has clocked in a gain of 4.5%, significantly outperforming the Nifty, which is a gain of close to about 1.5%. On to the top, gainers. Reliance Industries is a tad bit subdued ahead of its, numbers tomorrow. So keep your eye on that. Hi.
Hi, Rima. Good morning. So, like you were mentioning as well, a bit of a subduedness is what we're seeing in terms of the market after 7 consecutive trading sessions that decline. Volatility is obviously something that is there today because there's expiry as well. But, a sector that is doing well in this grim is pharma. Look at the Nifty Pharma. We've seen a bit of a spike coming in the last half an hour specifically as well. A lot of announcements today that have come in especially for these pharma names. So that is something that we'll be keeping an eye out on. We'll deep dive into all those names separately as well, whether Divi's, Thyrocare, GSK Pharma, Syngene, Lupin, all these names are something that have been buzzing in trade today. And specific reasons for that we'll get you through in the later on part of the show. But FMCG, let's just focus on that because today we had HUL that had reported its numbers sometime back. Now, post that we're seeing HUL is in focus, Nifty FMCGs, that's seen a bit of a furthermore decline coming in as well. FMCG is reacting to Tata consumer numbers. We'll have Nestle that is reporting its numbers today as well. Now, specifically on HUL, today as of now, the stock is down 3%. Overall, numbers seem like largely inline set of numbers in Q4 FY25. Volume growth is coming in at 2%. But to break down and analyze these numbers, Mangalam is here to give us more details on that front.
Well, Hindustan Unilever recorded an in-line performance in the fourth quarter, where the revenue grew by about 2.4%, the EBITDA grew by about 1%, largely in line with very muted expectations of the street. But what was positive were a couple of things. One, the company scaled back on some ad spends to ensure that the margins are, improving. Between 22 to 23% is the guidance that the company is given going forward as well. This, despite the volatility that we've seen in raw material prices. And secondly, the underlying volume growth this time around has come in at 2%. Most on the street were working with a number anywhere between 0 to 1%. So to that extent, there has been a positive performance that has come in. Add to that, the stock is at near 5-year average valuations itself after having underperformed. So the street believes that maybe going forward, there could be sort of an inflection point and improvement in the demand environment for the company itself. And that's exactly what the management has said as well. If you look at beauty and well-being, that grew by about 3%. Personal care grew by 3% as well. And home care delivered a 3% underlying volume growth. The company said that going forward, they expect demand conditions to gradually improve over the next fiscal year, for which they are committed to unlock growth for the company itself. So largely in line with muted expectations, a few bright spots and attractive valuations versus its 5-year average has the stock excited in today's trading session.
Okay, Mangalam, thank you so much for that. And we'll also go across to the management of HUL addressing the media after the Q4 earnings. Okay, let's move on and shift focus and talk about one of these pharma names that have been in focus today. Lupin, that's seeing a spike up in today's trading session. Why? Because yesterday we had spoken about this, right? The company was expecting to get an approval coming in from the US FDA. This was for the generic version of the drug of Tolvaptan. That's the drug that we're talking about. Now, obviously, the patent expiry has happened of this drug for the innovator. So that is why they've gotten this approval. Now, for Lupin, they will be the first to file of this product. They've signed in the press release, they've mentioned in the press release as well that there will be a 180-day exclusivity that they'll have on this generic drug as well. Other than that, they will be launching this product soon. They've not mentioned an exact launch date, but soon is what they've highlighted. Manufacturing this product in the Nagpur facility. Analysts, what they are highlighting, they expect this generic drug to have an opportunity for Lupin almost in the $150 million to $200 million range for FY26. And possibly this could contribute to 25% plus for Lupin in terms of FY26 earnings. Access Capital also has said that they have revised the FY26 EBITDA and profit outlook for the company, factoring an 8 to 10% increase furthermore from what their previous estimates were. So that is something interesting. A big drug coming in for Lupin with 180-day exclusivity is something that's keeping a stock abuzz as well, Rima, today.
Okay, but Syngene, that's the big casualty of the day, and there is some guidance cut. As in what the company is guiding for is lower than what the analysts hope to hear.
Absolutely, Syngene, the numbers were in line when you look at it. Nothing bad that came in terms of numbers. But for FY26, the guidance in terms of revenue, it's lower than what the street was expecting. Base business, yes, mid-teens is the guidance given, but for overall business, single-digit revenue growth is what they're talking about. Other than that, do not forget, FY25 was already a subdued quarter for the company. So if, apart from that, you're seeing more of a subduedness even in FY26, then that's something that's fearing the street. But other than that, they're expecting the EBITDA and the margin front also to be a bit subdued. Profits also to see a decline on a year-on-year basis in FY26. So that is some bit of a worry that's coming in for Syngene in terms of their numbers going forward, that is something that we'll be keeping an eye out on as well. But commentary seems to be a bit weak in terms of the guidance for FY26, and that is why today we're seeing Syngene that's down and out in today's trading session. But on the flip side, we have Divi's, that's buzzing in trade as well today. The company has actually, gotten, this is a note that's coming from Citi. Now, they are maintaining a buy rating. Target price is up to 7,050 rupees from 6,850 rupees. And this is mainly, they believe that, Divi's could be one of those players who will benefit from Eli Lilly's oral drug that is going to be launched or that's going to be coming up. They would be one of the primary suppliers. So because of that, they believe that this is a very big positive that could come in for Divi's. Three four 1 2 3 4 1 2 3 4 1 2 3 4
1 2 1 2 क्या हुआ क्या?
Okay.
अच्छा ठीक है.
Yeah.
हाँ. Welcome back. Let's turn our attention now to the commodity markets. Manisha, as promised, is now with us on the show. Manisha, what is the commodity that you're looking at today?
Well, I'm looking at the gold prices because the volatile moves in this space just about continue. After hitting an all-time high in this week itself at around $3,500 an ounce, we've seen some profit-taking come into the markets. Well, yesterday it fell all the way down to below 3,300, but it's holding above those levels at this point in time. And there is a volatility of anywhere between $60 to $100 an ounce that we are seeing in gold prices on an everyday basis. Not just international gold prices, but the Indian prices, after hitting almost a 99,400 level of a mark, have seen some decline coming in, holding around that 96,000 rupees at this point in time. But even with these corrections, if you look at the gold prices, they're up by 10% on month and up by 27% in this year until now. Well, the markets are looking at a few things which have led to some decline or some cap in the gains coming in. One is the dollar index, which did fall below 99 toward 3-year lows. That has seen some gains come in. And then there's a bit of a uptick in the global equity markets as well. So you have seen some gold money go in there as well. Markets also are looking at US indicating potential lower trade tariffs with China. There has been some retracting of statements as well about the US Fed independence. And that also has eased a bit of a safe haven buying that we saw in gold. But a couple of important developments, and that would continue to support gold prices. One is China buying gold. The central bank and the institutions have been, even the insurance companies are buying quite a bit of a gold. And March has been a 5th straight month of gold buying there. If you look at the numbers therein, well, China bought 50 tons in Feb and another 5 tons in the month of March as well. China has been buying for the last 3 years now, and that pattern just about continues even now. More interestingly, even as China is talking about internationalization of yuan, China also is looking to invest via Shanghai Gold Exchange in cents of gold. There are conversations and reports that gold trading in China could also be internationalized, and not just trading, but deliveries and warehouses also will be opened up to the world. That really comes in on a big one, and that has been supportive for gold. Well, that's about China. But when you look at the US imports of physical gold, they also have been on the higher side. They're actually categorized as industrial supplies and materials. So when you look at the US trade data, that shows you that in the month of November or for the month of Jan, we have seen very strong gold being bought into US. In November 2024, the holdings or imports per month was at around $2.8 billion, which we have seen surge in the month of Jan. This was ahead of tariffs. In the month of Feb as well, it has been a double-digit $1 billion of an import in US that we have seen come in for gold. Another important thing to watch is the statement that has come in from the Atlanta Fed official, who says that they are looking to introduce new GDP estimation model adjusted for gold trade. So there are newer developments coming in from across world, especially from China and US when it comes to gold trade, and that clearly would be supportive going forward. Global ETF holdings for gold also are at September 2023 highs, and the gold ETFs for US are at all-time highs. So various newer records being created there as well. So even as we are working with a bit of a profit taking in case of gold, Goldman Sachs, JP Morgan do tell us that it would be higher highs, all-time highs before we close this year. And then they are estimating $4,000 an ounce for 2026 as well. So, well, buy on dips does look like a strategy.
Absolutely. Buy on dips does look like a strategy. Right now, some profit booking, but going forward, maybe year-end, we could see newer highs coming in as well. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Vishal Mulkan of mulkansview.com and also discuss their top trading bets.
Welcome back. Let's revisit HUL. HUL is now the top Nifty loser, nearly 4% gone. It's at the 100-day moving average of 2,334. Volumes look fine at a 2% growth. So what's weighing on the stock? Sudarshan is now joining in. Sudarshan.
So you've heard from Mangalam about the earnings. Earnings were largely in line with estimates when volume growth has come in at 2% against our expectation of flat to 1%. But what is dragging the stock is the outlook that company has given. While it believes that H1 FY26 is expected to be better than H2 FY25, but on EBITDA margin front, now the guided range going forward is in the range of 20 to 23%. And remember, earlier guided range was 23 to 24%. Also, company says that gross margin is expected to moderate from current levels and price growth is now seen in low single digit. And one major segment, that is the home care, which has seen the negative price growth even in Q1 FY26. So while earnings were largely in line, but the outlook has weighed on the stock, and that's the reason you are seeing a sharp fall. It's down almost 7% from day's high.
Sudarshan, thank you so much for that. But let's cut across to my colleague Mangalam and Shilpa, who are in conversation with Rohit Java, CEO and Managing Director of HUL.
Pureit. During the year, we continued on our journey of sharply executing the Aspire strategy to unlock a billion aspirations. We have segmented our portfolio into core, future core, and market makers. Our segmented portfolio approach facilitates better allocation of resources to maximize overall organizational growth. In financial year 25, we continue to modernize our core portfolio with relaunch of Lifebuoy and Glow & Lovely, strengthened our market position in future core, and delivered double-digit growth in market makers portfolio. Our focus on transforming our business into high-growth spaces has led to a 200 bps shift from core to future core and market makers. We have accelerated our pace of transformation with sharper where-to-play choices. We acquired a majority stake in Oziva, a health and well-being business, in January 23. The business has since scaled up from an annual run rate of 100 crores to 400 crores. Last quarter, we announced the acquisition of 90.5% stake in Minimalist. I am pleased to inform you that we have completed the closing formalities as of 21st of April 25. We look forward to unlock the next phase of growth with Minimalist, which is now a part of larger HUL ecosystem. Pureit business divestment was completed, unlocking value of circa 600 crores. The demerger of ice cream business is progressing on track with regulatory requirements, and we expect it to be completed by end of financial year 26. In line with our strategy to strengthen business resilience, we announced the acquisition of palm undertaking from Vishwatej Oil Private Industries and announced our investment in Lucro Plastic E-Cycle Private Limited. The former will aid our palm localization strategy, while the latter is a step towards developing flexible plastics circularity. Considering our performance for the year, the Board of Directors have proposed a final dividend of Rs 24 per share, subject to approvals of shareholders at the AGM. Together with interim dividend of Rs 19 per share and special dividend of Rs 10 per share that we announced in October 24, the total dividend payout for this year will be 12,453 crores. Moving on to March quarter 25 results. Underlying sales growth was 3% and with an underlying volume growth of 2%. Gross margin at 49.8% was lower by 160 bps year-on-year. This contraction in gross margin was driven by commodity inflation across palm oil, tea, and coffee that wasn't fully priced for. EBITDA margin remained healthy at 23.1%, lower by 30 bps year-on-year. Profit after tax before exceptional items and profit after tax both grew at 4%, including the benefit of interest income on prior period tax adjustment. Coming to performance across the four business segments, Home Care delivered a robust mid-single-digit UVG, which translated to 3% USG as we continue to pass on the benefits of deflationary commodity prices to our consumers. Beauty and Wellbeing grew at 3% USG, led by volume. While Hair Care delivered double-digit growth, Skin Care was impacted by mass skin performance. Personal Care delivered 3% price-led growth, while UVG declined in low single-digit. Skin Cleansing, led by non-hygiene segment, continued its positive growth momentum. Oral Care delivered price-led growth. Foods turnover declined by 1% on the back of mid-single-digit decline in volume. Robust performance in beverage, ice cream, and packaged food was impacted by performance in nutrition drinks. Margins in all four segments remained healthy, with Home Care at 18%, Beauty and Wellbeing at 33%, Personal Care at 18%, and Foods at 16%. Moving to our near to mid-term outlook, we expect growth to gradually improve as a result of our accelerated portfolio transformation actions and improving underlying macro conditions. We anticipate first half of financial year 26 to be better than second half of financial year 25. If commodities remain where they are, we expect price growth to be in low single digit. Gross margin is expected to further moderate due to commodity inflation and our continued commitment to provide consumers with the right price-value equation. We will step up investments behind our multi-year market-making platforms, channels of the future, and strategic capabilities to successfully land our portfolio transformation. As a result, EBITDA margin will be maintained in the range of 22 to 23%. We believe this is the right time to accelerate investments as we chart the future course of growth for the company in the backdrop of portfolio transformation actions and improving macro environment. With this, we conclude our prepared remarks and I will take questions.
Hi, thank you so much on the volume growth. If I could just quickly touch upon the urban demand scenario, can you give us a little more clarity on how the improvement's been there? Are you seeing any rebound in the urban growth and also a little bit of the rural demand also? Give us a little more sense on the inflationary scenario also. You said low single-digit price growth is what you're expecting. Going forward also then, how do you see the volume to price mix also changing for the fiscal that we're entering into? And then on the same lines, then how do we look at the margin profile as well?
So maybe I can cover off the broad market shapes and then Ritesh can talk through some of the more nuanced points you asked about the price and mix. So broadly speaking, we've seen market growth subduing over the last few quarters, largely led by urban. Rural, on the other hand, is resilient and robust, and we see that holding up. And we do expect going forwards, macro triggers are positive. We see, of course, the food inflation coming down sharply. We see the interest rates also being reduced. That will impact the EMIs and therefore lots of urban households. The crude oil being softer also does impact the entire economy. The agricultural output is strong. The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro. Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years. And we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future, building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We are operationally quite robust. Our brand powers are strong, getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are the best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'd be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further. So we are being quite active and I would say leaning in aggressively on investing on our business. We believe this is the good time to do that, and it's a very opportune time to invest for the future of the FMCG in this country, which, as you know, is a long game, is a great place to be in.
Right.
So let me just add and pick up the other questions you had. So as Rohit mentioned, both we look at external atmosphere of macro conditions and what we have done internally to drive our portfolio transformation. Put together, there's a pretty strong case for us to further develop investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. To your question, where do you see the balance between volume growth and price growth going forward? It's a healthy mix as we speak this point in time, but as the year will progress, if commodities remain where they are, volume growth will be ahead of price growth.
Right. But which are these categories, Ritesh, if you could say, where we can expect price decreases and where can we expect the price increases?
Yeah, so home care is the category which gets largely impacted because of the crude oil. This is where, as we speak, in the quarter, we had a negative price, and this is where the momentum of pricing will be negative, unless, again, the signals of commodities end up changing. And price increase will be essentially in skin cleansing, which is where crude palm oil has increased, and tea category. Of course, tea, I'm very mindful. We are now not in season for tea production. The new crop will come in May and June, and we'll have a different signal, if at all, and we'll determine basis that what happens later on in time.
Right. If you could also just touch upon the margins bit that I was talking about. How do we look at the margin?
So margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Right. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And it will keep helping us to keep driving more amount of investments across the board.
Just to confirm on that, last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 22 to 23, and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today, what we're speaking about, that we are lowering that number to a range of 22 to 23, because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
So, first of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out, first of all, then zoom in. On zooming out, this is a market that premiumizes. In the long term, people are upgrading their quality of life, they want better products, and I'm not talking of extremely privileged or luxury products, but people climb up to a better quality of product experience at every level. That trend is secular. We do see that trend continuing this quarter and last quarter, although it's compressed a little bit. So instead of premium going much faster, it's sort of come down a little bit, but it's still faster. So there is a general upgradation trend, although it's muted compared to the past few quarters. We must not make too much of it and stick focused on the long term, because eventually the market has upgraded, we upgrade. We are a very, very low per capita consumption market at this point. Right. So that's number one. On the pack sizing, the large packs still are growing a little bit ahead. There is a trend towards downsizing. People are probably managing their budgets. Of course, as rural is growing now in the last few quarters ahead of urban, and rural consumption generally tends to be on the low pack sizes, that also weighted average makes an impact. So there are these twists and turns, but I would not overly focus on them. I think the market in all categories is at a very low per capita consumption, and market development is the main thesis for growth. Innovation, improving quality of our products, getting people to use something more better is the main thesis of growth in this market, and we stick to that in medium and the short term.
Any guidance with respect to growth where Minimalist is concerned, because beauty and personal care has done very well this quarter? What are the kind of targets that you are looking at right now?
See, we had mentioned as we acquired the business now, we completed the whole transaction 21st of April. We are very focused to unlock both growth synergies and cost synergies. Leveraging the R&D entire process and capability that we have as Hindustan Unilever, we will benefit the business of Minimalist with that. Our supply chain network of production capacities and our expertise in that space will end up giving synergies to Minimalist business. We will also aid international expansion of the business. And last but not least, Minimalist is by and large an online brand, and we'll end up leveraging the offline distribution. So these are the four elements of synergies with which we will now start running the business. We'll keep you updated in times to come how those synergies are going to look like. But we are very optimistic. It's a fabulous brand. very well positioned in the masstige skincare category. And we do believe now within the family of Hindustan Unilever, it will have a very bright future.
Welcome back to Trading Hour on CNBC TV 18. Now, let's get a check on the market, on the technicals. And we have Vishal Badkan of Malkansview.com joining in with us to give us that check. Vishal, morning. Thank you so much for joining in with us. Today, what we're seeing in terms of the market, after 7 days, we're seeing the red on the screen for Nifty below the 24,300 mark. What are we technically watching out for? Could we see a further fall coming in, or what are you expecting today?
Yeah, hi. I think the rally which we had in the last 7-8 days is a very sharp one, like a perpendicular one. So there needs to be some breather, which the signs are already there in the last couple of days. So it can be like a consolidation before we move forward, like between the range of 23,900 and 24,300 could be a good range. So there could be a small correction, or what we can say retracement, where it comes down to 23,900 or 24,000 and then take support and then move forward. So there would be some subdued market for the next few sessions.
What about stocks? Vishal, what are you recommending? And any thoughts on HUL and the fall to 100-day moving average that we've seen?
Just checking out on HUL has, of course, has corrected due to results, and there's a big candle, like big volume. So there is definitely some kind of resistance on those levels, and it can further go down to 2270, 75. That could be a good support where HUL can take support. So for the timing, I would avoid, especially because it is news driven or event driven. So I'll avoid and wait for a dip till 2270 on HUL. And as far as stock specific is concerned, I think one stock which is looking strong as of now on my charts is CDSL, which has given a good breakout about that 1350 level. So we can go with a buy on that with a stop of 1335 for targets of 1420 and 1475 in the next few trading sessions.
Okay, Vishal, thank you so much for that, talking us about the levels and taking us through the levels for the market as well as in terms of stocks. HUL as well as CDSL is something Vishal has mentioned and spoken about liking as well. But let's move on, and Devang Mehta from Spark Private Wealth Management is joining in with us to discuss market fundamentals and his top sectoral bets as well. Devang, good morning. Thank you so much for joining in with us. In this current global market scenario that we're seeing, domestic market, we have earnings that are coming in as well. Where do you see growth coming in? Where are you bullish on now going forward?
Good morning, Vinny. Thanks for having me on the show. I think very clearly the growth pockets are right now clearly visible in the market. What has happened over the last few days, to be precise, from April 7th, where I think market formed a bottom, and from there on, a 10% rally in the large caps and almost the same amount of rally on even the mid cap and small cap indices have been actually showing the market's resilience. Why I say that? Because it's extremely fashionable to be in and out of the market, and there are a lot of questions about probably raising cash or staying underinvested. But I think this is where clearly one differentiates that when you stay invested, you probably don't miss the best days of the market. And if you miss the best days of the market, your return suffers drastically. Now, coming back to the question, very importantly is which are the sectors which are sort of participating. I think there was a lot of hue and cry around which sectors would probably lead the rally. And if I can say, this rally has probably started from the bottom or whatever the last few months of correction. A couple of sectors come to mind. I think very clearly one theme which we've been very bullish on, the entire capex, manufacturing, infrastructure, capital goods, manufacturing, sort of this type of theme where there can be data centers, where there can be power automation, there can be lamination, there can be engineering type of companies. And these companies had undergone a severe correction, not only on the price front, but also on the valuation side. But if you look at the order book of these companies, I think the last 1 quarter where numbers were not so great, but if you look at all this order book of these companies, they've been generally very robust. Secondly, the government activity which had slowed down in the October, November, December quarter also saw a good bit of bounce in the January, February, March quarter. We have seen inflation cooling down. We have seen rate cuts, which helps the industry, which even helps consumption. I think budget also announced a little bit of measures for consumption and financialization. I think a couple of sectors, as I said, one capex related theme. The second, as I always talk, is more of discretionary consumption related to hotels, related to sort of lifestyle expansion. And the third is financials. And financials, definitely, I don't mean only banks. It is a lot of NBFCs, a lot of companies related to the broking or depositories, exchanges. I think there have been a dream run in some of this, but I don't think if somebody has a 2-3 horizon, why these companies would not do well.
You spoke about financialization trend, which is still very much intact, and exchanges, depositories, etc. What about wealth management? We just saw this big deal where partnership between 360 ONE WAM and UBS, sort of setting a valuation benchmark now for the wealth industry, wealth management industry, and the stocks. Your thoughts on this space? And is it attractive to buy in at these levels?
Extremely interesting space, Rima, to tell you the truth. Of course, as I said, we are in the similar space, and we know how in India the number of millionaires and number of billionaires are rising by the hour and by the day. The most important thing is this. The second important part is that as AUMs keep on rising, there are also alternates which have come to the picture. There is so much that people aspire for, and there is so much goal setting. There is so much of things which people want to sort of grow their wealth at a decent pace, right? So earlier, if you think about wealth management, there was just a couple of products. Now, because of the productization, because of the huge bouquet of products, right from equity to debt to alternates to structures to real estate to even overseas investing, I think it's a very interesting space. I think a bit of consolidation has started to happen, as you rightly talked about, a couple of deals, and most of the numbers that the listed players have shown so far have generally been good. So you're seeing a 20-25% type of growth in certain companies as well on even the revenue and the profitability front, which I think augurs very well. I think the size of the market is enough and more for everyone to expand, and even the market shares will be taken over by certain companies. So my sense, this is one prime financialization candidate, this wealth management or private banking as an industry.
Okay, surely find interest in the wealth management side as well. But Devang, I just want to understand in terms of pharma also, what is your thought coming in on that? You have not mentioned it anywhere, though you mentioned IT metals, more on the export-oriented side. Your view on the pharma?
So ideally, what we have gone ahead and told is that there are two things. One, wherever there is global dependence, wherever there are global linkages, now be it IT, be it metals, we know that what happened to IT companies. I think most of these large cap IT companies are trading somewhere near the 52-week low on unknown reasons, right? So most of these companies are growing their top lines by say 2, 3, 4% type of line. So I think probably they might give you returns in the tune of 8, 10, 12%. Even metals the same. Pharma, I think we are clearly bullish on India-centric companies, on MNC companies like About India. I generally just don't recommend ideas, but this is just one portfolio stock that we hold. Now, this is an MNC company which is more of a health tech. But the company has superb ROIs. The company come up with good set of numbers over the last 3-4 quarters. I think these are the type of niche companies that would like to sort of get into innovators rather than being a normal generic company. And you know that probably today the narratives change by the day, change by the hour. And if US announces something, I think again we see a bit of correction. So my sense that we would be probably more domestic facing. Even in pharma, if there is something domestic centric, we would be interested. But otherwise, generally there are so many domestic consumption, domestic financialization, and domestic capex oriented themes that there is ample choice. You are spoiled for choice to buy great companies.
Okay, Devang, thank you very much for that. Nestle numbers are up for you on your screen, and it's bang in line with street expectations. 885 crore is what the company has reported in terms of a bottom line, a slight moderation of 4% year on year, and the top line too at about 5,500 crore has come in line with street expectations. The stock currently is up close to about 1.8%. So after HUL disappointed the street in terms of its EBITDA margin guidance by lowering it, saying they'll unblinkingly focus on growth when it comes to growth versus margin trade-off, Nestle seems to have delivered and met street expectations. We'll await more in terms of the commentary, but revenues at 5,503 crore, in line with expectations, a growth of about 4-5% on the top line. Bottom line has seen a slight bit of a decline, a decline of about 5-6% perhaps in the bottom line compared to it on a year-on-year basis. But the stock is holding up okay. We await the margin performance and even the volume growth.
Absolutely, margin performance and volume growth is something that we're keeping an eye out on. As of now, seems like largely in line with what we were expecting. Nestle is managing to hold on to some bit of a gain as well in today's trading session. 1% uptick as of now, just around that 1% mark. In terms of commentary also, what they've said that, they are seeing beverages, confectionery, which is seeing a good growth coming in for the company. So that is something that is working out well. Margins is something that we'll be keeping an eye out on. But yes, on that note, we're going to slip into a very short break. And okay, actually, we have Prakash Diwan who's joining in with us as well. Prakash, good morning. And Nestle, in terms of numbers, what's your first cut coming in for Nestle? HUL, while it's a bit of a disappointment coming in on that front, Nestle seems to be okay. That's also gone into the red as well. So your first cut on Nestle.
No, so, I don't think there was any high expectation from any of these larger FMCG players because, demand revival is still some time away. Very clearly, even before the numbers were out, data was very clear, indicating that there could be still some softness because there's no volume growth. Even if they were to improve margins marginally, it's not going to make a big difference till volume growth comes. For both of them for quite some time. Nestle is probably in a better position given the price points that it sells at and the kind of product mix that it has. HUL has certain other things which at times pull it down, especially the high value, high priced personal care stuff, which Nestle doesn't need to worry about. So I think both of them are very similar. They tell you a very common picture. There's nothing, there's no outlier kind of a performance in any of them. So we'll have to kind of just wait for even the commentary to give you that assuage that doubt whether demand is going to grow from here. There's nothing very, very stellar about the numbers at all.
Naveen Kulkarni, Chief Investment Officer at Axis Securities, is also with us on this show. Naveen, in the FMCG staples, Nestle has a bias more towards urban consumption. And we just heard the HUL management where they're saying the macro triggers are positive and therefore urban will now start picking up. Up until now, it was rural driving growth or rural growth outpacing urban. But now urban should start looking up. Would you read that as a positive for a company like Nestle? And two, tell us about the valuation because, generally high valuations, elevated valuations for Nestle has always kept some people on the sidelines when it comes to Nestle.
Yeah, so the pickup in urban consumption going ahead is a positive, no doubt about that. And it should help Nestle probably more than other companies because the brand strength for Nestle is much higher. Their ability to pass on input cost increases, all those things are much, much better than most of the other FMCG companies. So that is certainly a positive. However, the challenges for Nestle are not so much with regards to valuation, but the overall growth trajectory, right? So the valuations, of course, vis-a-vis the growth appear to be a challenge. If growth were to pick up, right, then of course Nestle and the likes of HUL and others tend to have very, very high return on equity, right? So from that perspective, they don't need any significant capital to grow. So all those factors will essentially play out and then of course the valuations will get justified. But the critical element will always remain what is the growth versus the outlook going ahead, right? So those are the critical factors on which I would say that we will have to look at Nestle and Unilever.
Got that. Growth is paramount for all companies, and growth has been, in line with expectations, but generally we're still looking at very low to mid-single digit kind of a top-line growth. The Nestle share price has dipped down close to about 0.5%. Numbers are in line. We'll await the volume details and the commentary going forward. Get into a break. On the other side, by the way, we thank Prakash and Naveen for joining in. On the other side, Mangesh Bhadang from Centrum Broking will join in on the other side to talk about the latest trends